Alrighty, welcome everybody to another Sunday session. We've had a pretty interesting week, to say the least, in oil and gas markets, and it's been pretty funny because sometimes I think about the little disclaimers I give at the beginning of these presentations that some people are doing that just to cover themselves in any sort of lawsuit or anything like that. But really, along with that, some of the things that we share here in the oil and gas space about due diligence and some of the other risk tolerance metrics, I think apply more than somebody buying a mutual fund or real estate or some other instrument per se. So I think something to definitely keep in mind. I will rehash some of that here as we get started. But today we are back to our PetroNinja Wells update. So we did one in November, I want to say, of 2022. So it's been about 6 months. I like to do these every 6 months or so, get a new feel for what's happening, whether it's new wells, whether it's new technologies, new companies that are firing up with some brand new plans, or just as companies develop their acreage. I've kind of said this before, that I think there's a lot of technology and innovation that has occurred in the last decade, but Canadian companies just did not have the capital market support or the shareholder support that some of the American companies did, where they were able to really innovate and optimize their shale acreage. Some of the Canadian conventional side and even the Canadian unconventional side has suffered and it's lagged a bit, which of course creates an opportunity, not just from the companies that are obviously doing something great, but also from undeveloped acreage and companies that maybe did some acquisitions in the past where they never really got to capitalize these acquisitions. So they've just been sitting there with not much happening. And now the companies have finally paid back some debt. They got some dividends going. They have a little bit of a buyback going. And we'll kind of see how they do as the cycle continues. It's been very interesting to me that investors or whoever will write off oil and gas companies' acreage or what they can do with it, when we really haven't even had a chance to properly go and delineate these acreages. So we're at the very, very early stage of the cycle. The oil and gas industry is not a industry that operates just in time. We have a lot of secondary and tertiary safety nets. And with that, the way the system works is just very slow. So if I want to go and drill a well, it's going to take me a few months to get everything started, get the company set up, get the proper drilling plan, get the engineering plan, get my pad built, go and acquire all my casing and my tubing and my pump jack, go in and drill the well, complete the well, test the well, make sure I have all the regulatory approvals, and then we bring the well online. And then maybe there's some learnings on that well or on that acreage that then we spend 6 months looking at the well results. Then we go out and do another drilling plan for the following year. So given that way of doing things in the oil patch, things just work a lot slower. We are seeing some very interesting new developments. Everybody's obviously heard about the Clearwater and the Blue Sky and the multilaterals. Now we got the fishbone wells coming out. We got some of the unconventional wells being upspaced, which is something that you didn't really hear over the last few years. So a bit of a change in the way that companies are running wells and even the way that they're looking at wells. The mantra was production growth, so you would grow at any cost. Now the mantra is per well profit or NPV. So as we shift towards that a little bit more, you're going to see more optimizations and more individual wells having very, very good results, because companies are not scared of trying things in today's environment, but especially in a environment that's $80, $90, $100 plus environment. You will see companies take shots at single well exploration projects and just kind of see what happens. So this is where we are. Some of the wells will be repeated from November's update. There were some cool wells back then that I am going to bring back here. And then there's a lot of new wells here as well. So if you are looking for more of a background on this, I think I've done about 3 of them now, maybe 2 or 3 of them, along with sharing some wells in the evaluation sessions that I used to do last year. So just following up on that, I think well by well analysis may not be required for every investor in oil and gas, but it's something that for those who care about it, it's important to learn the not just where to find information, but the caveats around it and what the information really means. What kind of different results are we seeing across the board, and just follow the wells as you go, because I think this oil and gas investing is one of the only parts of the stock market where you can literally have an edge. And I think a lot of that edge comes down to tracking the well results and the nitty gritty on the engineering and the geology side of things, not just from single well results, but from looking at that single well and saying, okay, what does this delineate? How much oil can the company produce from the entire asset base they have, which can use this technology or is on this geologic trend or whatever, any sort of enhanced oil recovery, et cetera, et cetera. So a few things up front. I am not an investment advisor, so everything I share today is going to be my opinion, things that I've learned from both operating in the oil patch and from the engineering background, along with now the financial side of things. So please, if you do need any further assistance, please talk to your investment advisor, your registered investment advisor. Please do your own due diligence. The things I share today are by no means a end-all be-all of everything that's happening in the oil and gas world. It is just a snapshot, and especially a snapshot in time here as to where things are. It is my insight and my opinion as of today, what I see based on the well results. And there's a bit of speculation, as there always has to be in the commodity world. We don't always have all the information to run off of. If we did have all the information, then the companies would not be worth investing in. So we are running in a bit of a speculative manner, both from the commodity price and from the well results themselves. And I think a lot of us realize this who are investing in maybe some of the smaller companies as well. Please check your risk tolerance. I don't say this just to cover myself. I'm saying this because it's a legit, I wouldn't say concern, but it's a legit something to be cognizant of in the oil and gas industry. Things move very fast. Things move very quickly. On the financial side of things, companies can have their narrative change overnight. You can have big drawdowns, massive drawdowns in the oil and gas world. We have very few sort of investors looking at the space to begin with. We are obviously in a higher interest rate environment, so there's less participants in general. And this industry is one where you will frequently see momentum-based traders enter and then exit all at once. So please check your risk tolerance and please check your portfolio construction. The portfolio construction aspect of things, I think, is becoming more and more recognized as we go. People who are on margin, people who are doing options and junior companies and whatnot that are becoming a significant portion of your portfolio. Just check your portfolio construction, make sure you're happy with it. You have whatever fits the macro view you have in mind. There is not going to be any company out there that will give you X amount of torque on the upside, but then you also have downside protection down to 50 or 40 WTI. Those companies just don't exist. If you want the higher torque companies, you will have to take companies that have a bit of a higher break-even cost. Maybe they're more financially leveraged. Maybe they have more asset retirement obligations. It's just the way that finance works. It's just the way that business valuation works. Sure, can we find other companies in the middle of that maybe have a short-term arbitrage opportunity? Yes, but for the overall investing through the cycle sort of investment, usually it's risk versus reward. The question becomes, how many more units of risk can you take on, and does it justify the excess reward on top of that on whatever model you're running? I do have a mailing list as well. All I do is send out the Zoom meeting invites. That's it. So if you are getting the invites off the website anyway, may not be of help. But if you did want to join that mailing list to get the reminders, I can get you on there. Sometimes I do send the files up front too. Most recently, I haven't been sending any files, but in the future, if there is some of these PowerPoints that are public or that are corporate presentations, etc., I do attach them to those emails. So maybe of help, shoot me a DM or an email and we can get you on there. The Zoom is also recorded, so it will be on YouTube, just like all the previous videos, which are all on YouTube, and have been actually going pretty good. The upload method, YouTube has made it way faster than it used to be. especially for the 4K video, which was taking a long time previously, and now is a lot better. So that will be there, and then the Twitter Space obviously will be on Twitter as well. And the next few sessions, as I go throughout 2023, I've been really enjoying these more petroleum engineering focused topics and then more of the macro topics. And I've been getting a pretty good response on them. So we will continue with this. I have the schedule up on the website until the end of June, I believe. So we have one coming up on the different sources of software that I use, Vertexa, Rystad, Trail Profile, etc. We'll go over what the data is showing and why I feel like people who have certain access to data do have an edge, a further edge in the markets. Then we got one on well logging and reservoir analysis and economic evaluation. So very petroleum engineering focused topic. I will be actually referring back to my college files and some of the textbooks and the assignments and whatnot that we had back then. And I'll share some information on that. So that'll be for more of the very technically inclined investor. And then we have a couple coming up on the junior companies as well. There are a few new companies now that have formed, and I do want to kind of dive deep into them and share a little bit about what they're doing. And then we're going to end Q2 with the M&A review. So we're going to talk about all the M&A that's happened since early 2020 to now, and we're going to sort of grade them. We're going to see, okay, well, people were maybe not happy with this at the time. What is it now? Is it still a poor acquisition, or did it end up being a good little return? And it gives us a chance to look at acquisitions 3 years ago, 2 years ago, 1 year ago, and some of the ones that are happening here as we speak. So looking forward to sharing all of that as time goes on. And with that, I think we will begin. A quick reminder, anybody on the Twitter Spaces that would like to join for the Zoom session, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is there and you can join us for the visuals. If not, please feel free to keep listening in on the Twitter Spaces as well. So I did share a lot of macro slides on my last presentation, so nothing on macro today. Nothing really has changed. I think we have pretty much come down to the fact that the last week's drawdown was a lot of financial stress in the market. We had almost, more than 100 million barrels of financial contracts exit the market. So there's definitely a lot of financial stress from that side. Things look to have stabilized. We got the CPI report coming up this week, and that will really tell us how the inflation story is going as time goes on. But yeah, we'll get started with the PetroNinja Wells update. Today's update, the last one I did in November was alphabetical order by company. This one is more by area, geographical area and zone. So we will be discussing things from more of a zone standpoint, trying to compare how companies are doing, and then share a little bit of insight as to what I think all of this means. And then we'll leave it up to the individual investor to kind of dig deep further. PetroNinja, obviously, you can go into it. The basic version is a free version, so you can go and play around with these wells all you want and check out their production numbers and whatnot at your heart's content. So we'll get started with a Archer Exploration. So this is a new company that came out of the Anegada Oil Group once that got sold into the Tamaracks of the world, and a bit of that got sold into a couple of different entities there, split up, and we have them as the top oil well for March 2023. So this is a very, very strong company, privately held. It is run by a team that has had a lot of success in the past, a very, very, very interesting history. People who put their own money where their mouth is, and they put their entire net worths into the companies that they're building. So you can see a very strong geologic result here. This is up in the Charlie Lake area, 1,242 barrels per day in the first month, and about 1,691 MCF per day. So for a total sort of BOEs per day of almost 1,400 is where we're approaching here. So very, very good result. The Charlie Lake is a more an up and coming acreage. The reason why the Charlie Lake is so highly touted is because it gives you shale-like results, but your zone itself is a lot shallower. So the drilling completion costs are maybe half, maybe less than half of a similar Montney or Duvernay well. You're still getting these really, really good results. And the three companies obviously in the area now are Tamarack, Kelt, and then Archer being the third one. The one thing I want to point out here though is look at the hours. when you look at any well that looks really good in its first month, always look at the number of hours that it was active. In this case, this Archer well was only active for about 180 hours in March of 2023. So what is that? 7 to 8 days that it was active, which means your month one result is going to look really strong because you haven't had that week 2, week 3, week 4 decline that usually comes out of any shale or unconventional fracked well. So looks really good. RBC came out with a report saying this was a top well in March for liquids production. I would wait till next month and see what it is. So just a side point, any well you look at how many hours it was on in the first month, or any month for that matter, to correlate it back to the rate. But these companies themselves are doing really, really well. I would keep an eye out for more of these companies staying private as time goes on. So more of these geologic, technically focused companies, as their public company gets bought out, they then go and launch a private co and just keep everything private because the multiples are not that great on the public markets as of yet. They don't really need the public markets money, and they just do their thing. They don't have to reveal the same level of transparency on well results as they would if they were a public company. So I am focusing more on these private companies, tracking their well results, looking at what technologies they're using, because it does give you some insight into what the public companies then can use and make more barrels in a more efficient manner as time goes on. We also have an older Charlie Lake here from Archer. So you can see this one came online at about half the barrels, and look at the decline on it. So very typical shale, unconventional frac decline, but even more. And that's why it's important to look at the hours in each month that the wells are online, especially the unconventional hydraulically fractured wells. But look at this. They have almost doubled their initial rate. I mean, we don't have a full months of production yet, but they have almost doubled the oil rate here in less than 6 months. So some of the private companies do have a little bit more capital. They have a little bit more of a risk-on mentality, and they will do some interesting experiments that will further delineate these lands. And looking really good. Low water rate, high oil rate. And these are the companies that will then, as the cycle continues, be the ones that get bought out at very high multiples, assuming the cycle goes that way, which is what we're all betting on. And I would be very careful to see which companies end up acquiring at much higher multiples, because those will be the companies to avoid as the cycle goes on. The one nice thing with these new areas and new acreages is that the companies actually have a exit plan. So if there's a company that's buying old legacy Viking or Cardium or whatever, that sort of acreage, it becomes very hard to sell those private cos in the future. These ones that are delineating new lands can sell them with a lot of inventory with them, which may make sense for the right company looking to buy a longer cash flowing profile and more reserve lives and inventory when you're doing these acquisitions. The next one, which was another top well for the month. So we're going to look at some of the top wells to begin with based off the RBC report that just came out. We have the Nisku well that Aspen Leaf drilled. This is a ARC Financial backed company. They have made a few acquisitions over the years. They were looking to sell at one point, and then ended up making a really good acquisition of NEP Canada of this Nisku acreage. And these are very nice, lower decline wells that have been coming on really, really strong. And once again, it's a private company that's going out. They have the mandate to spend the money. They're not worried about buybacks. They're not worried about dividends. While companies are trading at 2, 3, 4 times cash flow, they're going and putting that dollar back into the ground in order to delineate new acreage. They're not going and growing massively and blowing through inventory. They're just wanting to delineate more acreage while things are where they are. And let's be honest, the oil field services costs are going to rise a lot. In an actual 100+ oil bull cycle, OFS can go up another 40, 50, 60% from here per well. So although it may seem like not that capital efficient to spend that money now on exploration, some companies who have good contracts, they got good connections, may actually find that it's working in their favor right now to do this before the costs skyrocket in this cycle. So very nice well, 800 barrels per day. We got a bit of gas as well on top of that, but you can see how the rates continue to rise. So unlike what we saw here in our unconventional well, where you saw the first month as your max month, and then it starts declining, some of our conventional wells, semi-conventional wells, actually rise. So we see month 2 is higher than month 1, and then month 3 is another higher than month 2, and it's now over 1,000 barrels per day. So really, really nice well here. Aspen Leaf has had a few of these now. I'll go through a few more here as we go, but they look to be very successful here in what they've done in the Nisku area, and very, very nice, possibly buyout target as well here as time goes on. Here is one of their older wells. So we see month 1 to 3 rising, and then it's fallen, but still, it's still producing, call it 14 to 16 months down the road, it's still producing over 600 barrels per day. So these are what I refer to as company maker wells. So when you have a small company, a junior co that's going out and doing some exploration, or even a small to mid cap company in the 10, 15, 20,000 barrel per day range that's going out and doing some of these drills, one of this well that can delineate 10, 15, 20, 40 other wells ends up being a company maker well. And which is why I think there's always an appetite for investors to go and invest in some of these companies. Obviously, as long as the valuations make sense. You don't want to invest in something that's way overpriced and you're betting on success. You want to invest in something that has no success baked in, and then they do hit something. And I'll discuss some more of these companies too as time goes on. So what exactly has Aspen Leaf found here? This is our Leduc area. So just south of Edmonton, Devon, Leduc area, we've got these vertical wells. We got about 16 wells a section, very, very tight spacing, vertical wells. This is one of the areas where oil was initially discovered in Alberta, the Leduc number 1. And the Leduc aquifer is basically this. You have this reef-like pattern where very thick acreage, tremendous wells that used to make over thousands of barrels a day each. And the companies like Imperial and whoever else was in the area back then went and they really jacked up the production. They produced a lot of the oil. It was very nice permeability, very nice porosity, lower viscosity oil that flowed very nice. And they produced a lot of it. And then they just abandoned all the wells. This is your abandoned well symbol on PetroNinja. So this little cross-like pattern, these wells are all abandoned. The black dot is your active well. And then these are also your abandoned wells. And I'm trying to find a suspended well here, but I can't see one. So I'll point it out on one of the next slides we have. But basically, Aspen Leaf went in and they found this Nisku aquifer on top of the Leduc. So think about it this way. When you're drilling vertically, you want your really thick reservoirs so your vertical section can access the most of the reservoir. When you're drilling horizontally, it doesn't really matter how thick your reservoir is. Obviously, the thicker the reservoir, the more productivity you're going to get. But at the same time, you can drill through very, very thin reservoirs and still make a lot of oil because now you're going horizontally. And that's what Aspen Leaf has done here. You can see their horizontal wells, some of them up to 3 miles long on the edges of the Leduc reservoir. They're also going into the inner portion where it makes sense, but they started off with the outside because that's where some of the oil must have gone trapped and not produced so far. And they're drilling these massive long wells that are producing such good results, and they have a lot of this area still to produce. You can see that they started off with these, call it 1.5 mile or 2 mile laterals. Now they're up to these 2.5 to 3 mile laterals, which are producing even better. So better well productivity and better economics as well on the wells. So looking really good. Keep an eye out for more of this. We call this bypassed pay. So we have all the well logs, we have all the drilling data, we got all the geology info, seismic, drill cuttings, cores. But in the past, people would not have gone into the Nisku because it's just not thick enough for a vertical well for it to make sense. But now that we have the really good geosteering technology on horizontal drilling, you'll find this becoming more and more of a trend. How much more bypass pay is there to find? It's really unsure. But when you do see some discovery somewhere, it's a good reminder that not only can it happen, but companies should be looking at this. They should have their engineering teams and geology teams scoping for this. And you, as an investor, can go and look at any PetroNinja well. If you have the other license, the professional version, you can actually download your own logs, core samples, results, cuttings, all that, and do your own analysis on some of the newer areas that are coming up, and also some of the really good wells that are being produced. So keep an eye out for more of this. Some of the new companies are looking into bypass pay already. You can look at some of the wells they're drilling, where they're targeting their zones. Some of them are perfing multiple zones in vertical wells to test them out before they go and drill horizontals. I will keep everybody updated based on what I see, but also the companies themselves seem to be becoming more transparent in terms of what they're putting out on their quarterly results and the commentary on the conference calls. And here is the interesting part. This Nisku reservoir was already identified in the 1990s. So here's a map of all the winter burn hydrocarbon accumulations, of which the Nisku zone is one of the ones in the winter burn. They had already identified this 30 years ago, 30 plus years ago. Now the technology is such that it can be produced, and you can see the way that Aspen Leaf has done their drilling around it. So looking really, really good. They have a lot more of the reservoir still to produce. They have all the internal section still to produce, and there's already infrastructure in the area from the existing Leduc formation production that was done over the last quite a few decades. So looking very good. And I would say, if anybody's really curious after the presentation, take this map and put it on top of a map of all the wells that are active, and look at which companies are active in these areas, and see if the winter burn has been produced in those areas. If it hasn't been produced, you kind of have an edge and an insight as to what's coming. And some of you will maybe recognize some of these names of these little areas, because they're owned by some of the smaller companies who are doing really, really well and drilling some really monster wells in these areas kind of out of nowhere. Well, it's not out of nowhere. We have all the information. We just needed the drilling technology to catch up and the capital markets to catch up in order to get there. So that's on the oil side. On the gas side, what do we have for top wells? We have Oventiv. Seems to be every single month they are on the top wells, no matter what month you look at. Their Heritage Montney is absolutely fantastic, looking quite good. They seem to be drilling a lot of good wells, which means they still have a lot of tier 1 acreage still to drill. Some of their NGL yields were coming down, but here's a well in March 2023, 23 million standard cubic feet per day. So we're talking about 3,500 BOEs of gas per well. Plus we have 927 barrels per day of condensate, and then an additional 700 barrels per day of NGL. So very nice well, looking really good. Seems like Oventiv is targeting dry gas and then the liquids rich gas separately. So doesn't mean that they're running out of liquids rich gas. They just chose to focus on different areas depending on where their infrastructure was, depending on where they had processing capacity, and just depending on commodity prices. So very nice well. Oventiv's Montney is one of the best Montneys out there according to kind of the gas rates. However, it does seem to be declining pretty fast. The wells do have a pretty significant decline rate on them, and Oventiv's overall production in the Montney is relatively flat, despite them hitting these really, really good wells. So we'll see what the plan is here going forward. Are they going to accelerate development, or are they going to slow it down a bit and then let the declines reduce their production a bit? So definitely a big overall call it change in AECO supply demand, and overall Alberta and Northeast BC supply demand. If Ovintiv slows down the program a little bit, you could see a pretty significant drop off in the production compared to how big the Alberta production is. The Alberta and NEBC production is not that much, 18, 19 BCF. If you end up losing 1% of that because XYZ operator decided to slow down, it does end up making big differences as the years continue. Here's some of their older wells. So you can see this one was even bigger. It came on at 35,000 million standard cubic feet per day. And in about 6 to 9 months, it's declined about 50%. So they do decline pretty heavily and then stay there for a bit. You can see pretty nice condensate and NGL yields here too. So they are making some pretty good liquids out of these wells. And then they have other wells that are basically dry gas. So we see these wells, same thing, came on at 37 million standard cubic feet per day, but the NGL rates and the oil rates are much, much lower. And will be something just to track if you're an investor in this, because condensate prices are higher, but the NGL prices right now are super depressed. So really just depends what the company's doing and how proactive they are. It is interesting that Ovintiv did make acquisitions in the Permian rather than acquire more Montney. Goes to show where their priorities lie. To some extent, it may also show you where they think they have better acreage. If they think that Montney acreage is top notch and they don't need to acquire, that could be the other way to look at this, their acquisition in the Permian that they did a couple months ago. Okay, some of the other really, really nice wells that came out of nowhere. Islander Oil and Gas. This is a private company that was just launched pretty recently. They are drilling in the Pekisko zone up north, so just north of Edmonton. I want to say quite a few miles north of Edmonton. They've got these Pekisko wells, tiny little laterals, and more than 600 barrels per day. So we're talking company maker wells. For those who are familiar with the Pekisko zone, you might think about Pine Cliff, who I shared in the earlier PetroNinja wells update. They had a really good production wells in the Pekisko. Now we're seeing this zone being further exploited. There's also the Pekisko zone in the Brooks area in Alberta, where a Torxen is very active, and there's some new other companies also coming into play with this very light oil, pretty cheap drilling metrics, and very high production wells. When we look at Islander's older Pekisko wells, looking still pretty good. Like they've really made a lot of money from wells, especially because they got the 2022 boom in pricing alongside that. But also, in general, you don't see very small stubby laterals making this sort of production. So they have come onto something here, and I would keep an eye out for the Pekisko zone in general across Alberta, because it's the same way. It has its different areas where it is. It's not one contiguous belt. It's certain areas of them are very productive. So any company that you're in that has Pekisko acreage, I would definitely watch even more closely here going forward. Look at the well results and what comes out of that. So Whitecap, we got the Wapiti Cardium. I had discussed this in the last wells update, that something in the Wapiti Cardium has changed. This is the area I used to work in, where I did the field operations and the field engineering at that time, 2019 to 2021 here. And we had some pretty decent wells. Like they would come on at 400 barrels per day, but then in 6 months, they were down to sub 100 barrels per day, and then stay there for a long, long time. Very waxy oil. So pretty difficult to produce at the lower rates, because you lose that reservoir temperature, you lose that reservoir pressure. And it ends up really creating a lot of wax and asphaltene. Very difficult to produce at that point. But something has changed in the last 6 months, in the last 12 to 18 months. We're now seeing these Wapiti wells come on at 500, 600, 700 barrels per day and have a much shallower decline rate. So both Whitecap and Tourmaline are showing these well results. I3 so far doesn't have them. So it will be interesting to track. It is call it a catalyst, not for the share price, but for their production overall. If they can also start drilling wells like this in the Wapiti Cardium, which is a relatively underexplored area. When you look at it overall, there's really not that much exploration being done in this area. the Wapiti Cardium sits in an area where the Cardium goes from 100% water to 100% oil. So just try and visualize this. There is a break in the system where to the, I want to say to the northeast, northwest side, it's 100% water. And then there's this break where you have emulsion. And then once you get into the Wapiti Cardium oil zone, there is no formation water. It is 100% oil, which makes the netbacks on this asset very, very nice, especially if you have a lot of drilling locations still to be produced. So as the technology gets better, as the well results get better, now you get better production on every single future well, and you get more reserves per well booked to the future wells, plus your NPVs on your current wells are a lot higher. So you can see why looking at things a little bit more zoomed out is a better way of doing things, rather than looking at just one well result and saying, oh, great, the NPV of this was XYZ. It doesn't tell you the full story as to what the impact of better wells is on the overall acreage. And I think that's really something I really want to get across. That point is good wells now end up giving you way better returns throughout the cycle, not just on a single well basis. It's an overall cycle benefit. And companies that are ahead of the curve, companies that were able to pay off their debt early, companies that were able to get into buybacks early, companies that were able to make good acquisitions early, are definitely on a call it edge up, a leg up in terms of how much benefit they can get throughout the cycle from these additional discoveries and better production optimization and better drilling. Here's an older Wapiti Cardium well, so you can still see a pretty significant decline on it right off the bat, but they were able to get this production back up and then back to its low decline and staying still above 150 barrels per day, which is pretty good for a 16 to 18 month old well at this point. So looking good. The gas rate is also looking good. You want a higher gas rate, not too high, but high enough that it can still continue to bring that oil up the tubing, and the well doesn't just die. So very nice. There's a question here. What's the average in the Wapiti Cardium area? So it used to be 150 to 200 barrels per day, I would say, for your IP 90. Your IP 365 used to be maybe 100 barrels per day. Now it looks like we're maybe 2 to 2.5 times that. So quite a big change, and relatively easy wells to drill. They're not all that complicated. So nice little Cardium pool for both Tourmaline, who bought it off Modern, and then Whitecap, who had the existing legacy pool as well. Yengera. So this is Yengera's Cardium. This is a company that has highly touted their Cardium. They've drilled some exceptional wells, very similar to what I just showed in the Wapiti Cardium. Yengera is more in the Pembina Cardium. But either way, they had some really good wells. These days, not looking very good. So the wells are coming on at 140, 150 barrels per day. And within a year, they're down to 20, 30, 40 barrels per day. So these wells are very difficult for two reasons. One is that you don't get the net back or the cash flow or the NPV on the well itself that you want, but also it becomes very difficult to sustain a company's production profile when you are not getting good wells and they decline so fast that they effectively become meaningless in terms of your BOEs. You get more gas BOEs, you get less oil BOEs. So when the company tells you we're X% liquids and we're going to grow 20%, think about that. Your liquids percent is going to go down no matter what in any sort of non-conventional hydraulically fractured wells, whether it's the Cardium, the Viking, whether it is the Montney or the Duvernay, etc. In most cases, you will find if they continue at the same development pace and they want to grow X% per year, as Yengera does, your liquids percentage is going to drop. And with that, your cash flow per BOE or your net back per BOE is going to drop. So if you're running a model on 2023 or 2024 on these companies and you're you're using the same production growth at the same liquids percentage, that's not the right way to do it. And here's example number one. Your gas BOEs have gone from, call it 75 to about 100 BOEs. Your oil BOEs have come down from 140 to 30. So as a liquids percentage on the well, you've gone from about 60% liquids to roughly 20 or 30% liquids in only 1 year. So what's going on in the Cardium? We have some interesting things happening both in the Cardium and the Viking. Both of them have a upper Viking/Cardium and a lower Viking/Cardium. The upper Viking used to be the place where people went, same with the upper Cardium, because it was just a better porosity reservoir. It was less tight. You had more permeability. It made sense if you're going to frack it. Okay, let's frack something that's a higher permeability anyway. But the problem is there's shale streaks in the upper portions of these two zones, which means once your frack hits that shale streak, if it fractures that shale streak, your frack stops right there. It doesn't hit the rest of the zone. The other thing that can happen is you don't have enough pressure to break that shale, and your frack propagates laterally as opposed to going upwards or downwards where you want it to go. So with the latest technologies in fracking and some of the higher intensity fracks, we're also able to get more oil out of lower porosity zones, lower permeability zones. Now the lower Viking and the lower Cardium is becoming more interesting. So why? Because even though it has lower porosity and it has lower permeability, it is a much thicker unit in a lot of cases. And also, it doesn't have the shale streaks. So you know your frack is going to hit the entire area that you're trying to hit. And that's exactly what's the changes that's been happening that could explain some of the reasons why the Wapiti Cardium has gone up a lot and why you're going to see increases in the Pembina Cardium now as well. As time goes on, some really, really good wells in that area. And the way to kind of visualize this. So let's say you're standing right here on a beach. So think about any beach that you are in, that you go to today. You're standing on the beach, and effectively the ocean is receding. So the ocean is going inwards, back out into the ocean. So you get more and more exposure to the beach as time goes on. This is just the way that geologic cycles have worked hundreds of millions of years ago. So the water is receding inwards. In the shallow areas here, you're going to have more porosity because you don't have as much pressure on the water. The water column is not as thick. You're going to have your more porosity, more permeability, your oysters or your seabed fungi and all that is not being pressured up as much. So it maintains more of a sponge-like look. It has more porosity, more permeability. That's it. Porosity is the amount of holes between your rocks or your dead organic matter. Permeability is how connected they are. The less pressure you have on some sort of dead organic matter, the more porosity and the more permeability you're going to have, which is why your upper Viking is exactly that. But you also allow other things like shales and clays and muds to come in and settle down there because they would fall off your current, where you're standing on the beach, they would fall into the ocean and they would stay there, get deposited along with this organic matter. Your lower Viking is further into the ocean. So further into the ocean, you have more pressure, you got more water column on there. So you get a more tighter rock, you get less porosity, but because it's that tight, other things that are falling into the ocean or coming in don't get a chance to get into this area, which means it's a much cleaner sand. That's literally as simple as it gets to explain the difference between these two. You can look at Yangera's corporate presentation for more information. They call it bioturbated cores. They call it upper sand, lower sand, however you want to name it. But effectively, the lower sand, adding the lower sand has increased the OOIP, original oil in place, by a factor of 2 to 4 times. So by fracking both the lower and the upper, or just the lower Cardium, you're seeing very, very nice results. Some companies have gotten a lot better at this. Some companies are still a year or two behind. The point I want to get across is the oil is now there. The oil can be accessed. For companies that have good lower Cardium and lower Viking acreage, you should see better well results here as time goes on, and you are seeing better well results. The Cardium is showing much higher well results despite being a very legacy old acreage, and I will discuss this here as the presentation goes on. The Viking now suddenly is showing 200, 250 barrel per day IP30 oil wells. We never saw that before. So keep an eye out on not just drilling technology, but new fracking technology that's able to go down further and access some of these tighter zones. And here we see exactly what I just described working. Literally 10 to 15 kilometers northwest of Calgary. The city limits, from the city limits, maybe 5 kilometers, 3 miles for those of us who are in America, northwest of Calgary, where, I mean, you would think this would be the easiest acreage for anybody in Calgary to go and buy and then drill. But nobody came up with this lower Cardium concept until recently. And we got a company, Orlin, that has now drilled a well over 800 barrels per day. And now in month 1, 2, 3, in month 4, it's still over 700 barrels per day, roughly 700 barrels per day. Very nice Cardium well. Lower decline looks like, higher upfront production, and it's right there. The low-hanging fruit is the juiciest fruit sometimes. So just give me 1 second here. Remove one of these users. Okay. So yeah, so looking really good. We have some really good results, not just from new areas being developed in the Cardium with this technology, but also older areas getting a revitalization. So keep an eye out for this. For anybody in the Cardium that thinks it's a beat up old acreage, it is. But we now have the lower Cardium, which is a completely different zone, has a lot of oil in place and can be targeted using the latest frac techniques. So definitely an exciting one for those who are in the Cardium. Switching to the Montney a bit. So we have Hammerhead. They just went public on the NASDAQ and on the TSX as well, maybe. Drilling wells in the Montney, over 1,000 barrels per day for a couple of months. We then go to our typical decline here on any sort of Montney well. The gas rates are looking really good too. When you have Montney wells, you do want gas rates to be relatively higher off the bat because it does help bring that condensate out of the ground. Some of these wells are very, very deep, so we need that help. We need that pressure and reservoir support to bring it up. And also some of these Montney wells, they go on gas lift right away. So as soon as they're online, the gas is taken out of the stream and re-injected down the well to keep providing that circular pressure support. So having that gas already there gives you a leg up on infrastructure, and it also allows you to maintain your reservoir pressure for a lot longer. So watch for not just the oil rates, but make sure your gas rates are looking really good too, and brings it up. You don't want massive gas rates either, because gas is going to be higher pressure than liquids, and it can preferentially flow and block off your liquids flow. So reasonable ranges where you want this in. This, I would say, is a pretty decent gas rate, like almost on the high side for the amount of oil they're producing, but still pretty good. Pretty good results here from Hammerhead. They have somehow come up with really good results as soon as it went public. So keep this in mind. I've spoken about Occidental in the past in the US, in the US Permian. What they were doing was flowing wells without any chokes, without any pressure control. And although it allowed them to have really good IP rates, the wells are not managed properly and they decline a lot faster. So I'm watching this very closely to see if Hammerhead actually has drilled much better wells, or whether they're just flowing them with less pressure control and it's going to play out in higher decline rates over a longer period of time. You can see there's some wells that are suffering pretty huge decline rates already, month 2 after peak. Something to track, something to keep an eye on. Too early yet to make any sort of significant conclusions. This is Hammerhead's wells here. So you can see they have 9 wells already, and they're looking for like an 11 to 12 wells per section drilling. So downspaced. They're very downspaced. The difference between each well is not as big as something like this, which is Arc Resources. Arc Resources only goes for 8 wells per section. Hammerhead looks to be going for 11 to 12 wells per section. So we'll see what results in what. Are the Arc Resources wells better? Maybe. But can you extract more oil per section and more petroleum per section by drilling more wells? The jury is still out. We will keep an eye out as to what goes on. The mathematics around should you downspace or upspace relies a lot on individual well cost and individual well productivity. So are you going for maximum reservoir contact and production, or are you going for maximum net present value per well? Companies are going to have different mandates, and those mandates will change as commodity prices change. So in a commodity price environment where, let's say, WTI and natural gas are way higher, and yet drilling costs are still down, you would likely downspace. If you had a scenario where WTI goes way up and gas goes way up, but then drilling costs go way up, now it all depends on, should we upspace, should we downspace, should we keep them where it is? We'll find out. And then here are CNRL's Dunvegan wells. So different zones, different well spacing. This is Montney, Hammerhead Montney. This is Arc Resources Montney. And then this is CNRL Dunvegan. You can see only 4 wells per section. 4 to 5 wells per section is what they're targeting. So always keep this in mind. Just because they have these wells here doesn't mean they can't change it, upspace, downspace, or even infill drill in the future, where they'll drill a well right in the center of this to access all the reservoir that was missed. We don't know. And that's why reserves, I think, is a very, very complicated science. And reading just reserve reports without going into the wells and looking at them, what they actually look like, where the undeveloped land is, it's very hard to gauge what a company's reserves are just off a 1-year reserve report. Here's these Arc wells down here, Arc Resources wells. Even better. 1,600 barrels of condensate, stayed there for a lot longer. And then in its decline phase, we see the gas rates are a little bit lower compared to what Hammerhead is producing. So it looks like Arc has a little bit more oily acreage with some more liquids yields, still producing really well. And this well is going to have paid out many times. Well, not many times, but it definitely would have paid out, especially in 2022, given that they were producing 1,600 barrels of condensate every single day. So very nice production. And Arc Resources is kind of a anomaly, I would say, because their 7 gens productivity was declining, and now it's taken a step up again. So whatever's changed in the last 6 months to 12 months is definitely being noticed on the production results. So I was not very happy with Arc Resources when I sold my position in June. I was seeing well productivity degradation, pretty major degradation, and now looks like they've turned the corner and come back up here. So very closely I'm tracking this, and it was one of the reasons I rebought back into my Arc Resources options position earlier, well, last month now at this point. Similar well, older well. So you can see how the wells used to come on at more than 2,000 barrels per day of condensate. Absolutely prolific. This 7 gens Arc Catwa acreage is just phenomenal, and really nice decline rate on it, about 60% on the liquids for year 1, and then it flatlines at about 200 to 300 barrels per day, which is in itself a really good condensate rate for being more than 2 years now into it. This is a really good well. no matter how you put it. And it's one of the reasons why 7 Generations was able to grow from 0 to 200,000 BOEs per day in 5 years, because they had wells like this that not only produced a lot up front, but they didn't completely die off. They would still be producing, call it, what is this, about 400 to 500 BOEs per day 2 years down the road. Vermilion's Montney. So this is Vermilion's, some of their legacy Montney, I'll call it, the older wells. Pretty nice gas rate, oil rate, 250, 275 barrels per day. Not anything out of the park. A decent little Montney well. Is it economic at $70 oil and $2 gas? Not really. No, I would not be drilling these wells at that environment. But in a $100 oil, $5 gas environment, yeah, they've got hundreds of locations like this that they can drill and grow out. So more of a positioning for the future as opposed to positioning for the now, because these wells, the NPVs on them, I bet you are not very high in a today's drilling environment. Here's some other older wells. So a little bit better, 350 barrels per day, nice gas rate, a little bit higher, 4+ MMCF per day. So 600 BOEs of gas as well. Pretty nice. This well would be a little bit more economic than this last one, but still not a gangbuster by any means. Here's some of Vermilion's latest wells on the La Crata acreage. So it's only month one. Month one is very difficult to say. As you can see, your liquids rate usually goes up in month 2 and 3. So not entirely sure yet, but it's only come on at about 120 barrels per day. And the gas rate is about 2 MMCF. So nice start. We'll see what month 2 and month 3 brings. Hopefully a higher boost, just like the other wells are. Here's another one. So very similar, very similar gas rate, very similar oil rate. And then we have a kind of what I was saying as far as the monthly production should go up in month 2 and 3 to about 2.5 times what the month 1 rate is. But pretty severe decline rate on this well already. So unless they're having some operational issues with the winter or some other problem, so far not a good sign on the Vermilion Montney. Now, it's still very early. They still have a lot of acreage, and a lot of these wells are still very economic in a higher oil price environment. But at today's pricing, these are not the Montney wells that you want to drill. So we'll continue watching this and tracking some of their new results. They did mention in the conference call that they had 2 wells now that just came on at more than 1,400 BOEs each. So I'm looking forward to seeing those on PetroNinja and tracking them to see what changes were made and what exactly the rates are of those wells. So not all hope is lost. They did just drill 2 and press release them, probably because they were getting questions as to the credibility of their Montney acreage. So a good sign. Q2, we will have more information by the time Q2 results come out as to how those wells are performing further down the road. Okay, we got the Spartan Delta Montney. So this is just a 1 well that I'm going to share. This is part of their natural frac area, which was discussed in various previous well updates. You can see how the gas rate is relatively lower than some of the hammerhead stuff, but the oil rate is still fantastic. And we still decline down to this 200 barrels per day. I like wells that don't continually decline. You'll see Montney wells that go up and then go all the way down to like 20, 30, 40 barrels per day. You don't want wells like that. You want wells that sustain 200 to 300 barrels per day, because that's a lot of money. Like a 300 barrel per day well on a typical month will still give you something like $500,000 to $700,000 of net back in just liquids production alone. So that means if you can sustain that rate for a year, you've paid off your well one more time just with the liquids rate after you got all your initial production at much higher rates. So Spartan Delta has a lot of this good acreage. Obviously, a lot of it is going to end up in Crescent Point's hands, but the Logan Energy entity that remains does still have a significant amount of undeveloped and unexplored acreage. So both become very interesting entities from this point forward. Back to oil for a bit. Here is Cenovus and their heavy oil. This is some of the stuff they bought from Husky in the Lloydminster area. And look at these wells, just fantastic. 1,500 barrels per day. This is your heavy oil in the Lloydminster belt. They use very, very advanced sand control devices. They use very, very advanced drilling techniques, bring it up. Then they upgrade it at their Lloydminster upgrader to a higher spec quality of oil and can sell it for a lot of money. So Cenovus did get a lot of junk with the Husky acreage, but the Lloydminster heavy oil belt is really good, very low operating cost. The production rates are absolutely fantastic, and they produce for many, many, many years. Like I'm talking 40 to 60 year wells. So, Cenovus, yeah, they've got the SAGD stuff. Everybody already knows about that, so I'm not gonna harp on that. But Cenovus has this heavy oil pools that they got from Husky, which are also really strong, very high netback pools. And I was sort of hoping some other company would buy that was smaller, because you could actually partake in the upside from these pools, as opposed to getting stuck in a Cenovus where, yeah, they're absolutely fantastic pools, but you can't really bet on it because Cenovus is such a huge company anyway that it really doesn't make a difference to their overall production to the extent that you would make a bet on just that. Here is another picture. So this one came on at 3,000 barrels per day, and a few months down the road, about a year down the road, it's still producing about 1,500 barrels per day. And you can see the way these heavy oil pools are. So we went from talking about 10 to 12 wells per section in the Montney pools. Look at this. We got upwards of 20 to 30 wells per section here. And just this very small section, one section can produce tens of thousands of barrels each. So this is the benefit with heavy oil, and why I've skewed my portfolio more towards your conventional heavy oil side of things. The volume of reservoir present and the volume of oil present is just absolutely insane. And the recovery factor you can get off that is also really good. So on a Montney well, you might produce 5-7% of the oil in the ground. With these kinds of situations, you can produce 30, 40, 50% of the oil in the ground, especially if you do an enhanced oil recovery after the fact. So very tight, clean area, and everything is in one place, and still further upside here for further development as time goes on. And Lloydminster area and Saskatchewan, west central Saskatchewan have a lot of these pools that have so far not really been produced because the capital expenditures on them are very similar to something like a SAGD facility. So think about what Strathcona bought from Serafina, those sorts of pools. You still need to spend a lot of money up front to build those. And you might see a lot more activity in this area as time goes on, which is, I think, something that we have to track, not just as investors, but also somebody tracking Canadian overall production. Because these pools can come online and produce a lot of oil and sustain that for quite a while. So we got Athabasca, Leesmer. So this is a SAGD now well. So very similar to the heavy oil wells, we get a huge production up front. It declines, then it builds over time. As that steam chamber gets bigger and bigger and bigger, your oil viscosity reduces, and then you get your slow decline. But the wells are still really good. Like 10 years down the road, this well is still making 200 barrels per day. So definitely, why do people prefer SAGD? Because of its capital efficiency. Once you have your infrastructure built, it's just so cheap to get these wells running, and they operate forever, which is what you want. You want a cash flowing entity with a low decline rate that just cash flows out forever, rather than these high decline shale wells over and over and over. Here's a newer well. So you can see, got started. Now the steam chamber is developing and being produced. Oil viscosity is reducing. and we get really nice flat production for many months at this point. You will not see this very often. Not even on a conventional oil well is this common, let alone any sort of unconventional frac well, where it's pretty much zero chance of something like this happening. Here's a Cenovus SAGD. So we talked about Athabasca's project. Here's a Cenovus well, 3,700 barrels per day out of one well, consistent and still rising. Looks very good. Those are the kind of wells that you as an investor want to own or be invested in. Hemisphere is running things a bit differently. It's also heavy oil, but they're doing a polymer flood to achieve the same oil recovery. And, very nice, came on, wells coming on over 100 barrels per day, slowly going up. This is one that it's a very interesting pool that they just started the polymer flood a couple of years ago. It takes a while for that to show up in well results. And now they're doing a lot of optimization and production work in order to get these rates maximized and pretty good. So these wells, obviously not as prolific as SAGD wells, but they still produce at a constant rate for a long, long time. You can kind of see one here that's a bit older. So this well in November of 2021 came online at 75 barrels per day. Today now, this looks like an older graph, but about a year down the road, the production is more than 2x. So when you look at heavy oil, polymer flood, water flood wells, keep an eye out not to judge them just based on the first few months. You got to watch and see how they perform as the enhanced oil recovery is implemented and everything sort of plays out over time. Hemisphere also tried the Pekisko. I talked about the Pekisko earlier in the presentation. Hemisphere had some Pekisko land near their Atlee Buffalo pools, and it didn't work out. So the Pekisko well so far is producing 2 to 3 to 5 barrels per day. We'll see if they have some other plans with this. Maybe they want to put it under some sort of water flood or polymer flood as well. We'll see. But so far, the results are not even close to what the Islander Pekisko or the Pine Cliff Pekisko wells were coming on at. Like this well makes 1% of the oil compared to those wells. Baytex Peavine. I mean, everybody knows this is the top acreage in the Clearwater thus far. We know the wells and how prolific they are. I'm not going to keep going on the same topic, but I will make one small point. There has been some concern about Baytex and some of their Peavine wells not doing as well. I have spoken very negatively on their shale acquisition they just did. But as far as Baytex overall, there's been some issues with their production. Oh, their Peavine wells maybe are not coming on as strong. There may be acreage degradation. Well, let's look into it a little bit deeper. So their top wells, well, all the top wells in the Clearwater, Baytex has 19 out of the top 20. Well known. Look at where the top wells are here. 1 of 30, 7815. Right there. That's that well. 8 of 30, 7815. Right here. We have 6 of 27, 7816. Right there. These ones here. We have 9 of 30, 7815, again, up here. And some of these other wells. 11 of 31. You can see this is a shorter laterals up here. But what is the point I'm trying to make? Look at this acreage. They have not drilled near their top wells. So they drilled these monster wells, producing really well, and then they stopped drilling in this area. They went to a different part of their Peavine acreage and started drilling. So it's not that they ran out of these really good wells and all their acreage now is trash. It's all their acreage is degrading. It's not that. It's that they just went to a different part of their Peavine area. If they come back and start drilling in these sections down here, over here, up here to the east, they will get these monster results. What they're probably doing is trying to figure out something on the technology side of things, something on the drilling fluid side of things, something on the geosteering side of things before they come back and extract this top-notch acreage. So don't be concerned yet if you're a Baytex Clearwater investor, you like this acreage. It's all sitting there. It hasn't been produced. And that's why some of their newer wells look like they're not performing as well, because it's in a different part of the Peavine area. And you had all this juicy 1,000 plus barrels per day wells still sitting here waiting to be drilled. So when you see them take out well permits here and the drilling rig comes on site here, you can bet that the next 2 quarters of production after that are going to be really, really good. Despite the fact that Baytex is now a much bigger company, you will still get a lot of outsized impact once they get into this part of the Peavine. So I once again will say this, looking at just well results, looking at just production, and trying to make some sort of conclusion as to acreage, not entirely the right way to do it. You should be looking into things a little bit more in detail, especially if it's a company that you really believe in, you have a large part of your portfolio in these companies. It doesn't take very long to just do this simple types of analysis, rather than just looking at reserve reports to tell you what's happening, or just looking at cash flow to tell you what's happening. It's worth doing the work. So Vermilion has some really good wells in the Frobisher. So now we're going to move to Southeast Saskatchewan area. So the Frobisher is very cheap. You can drill wells, complete DCET for about $1 million, 1.2 million. And look at these wells, over 500 barrels per day. And in month 5, it's now at 550 barrels per day. This is a absolutely tremendous well. You get really high netbacks in the Frobisher area, and the drill cost is so low that you're just making so much money in month 1, 2, 3. Everything else is gravy. It's all profit at the end of that. So well like this, that has cumulatively produced 40,000 barrels thus far, maybe a little bit more than that, 50,000 barrels at a $60 netback. It's already made $3 million on a $1.2 million drill at max. So, and that's only six to 7 months in. So these Frobisher wells, if you can hit them really well and you have a lot of inventory, drilling inventory, definitely a very, very economic acreage. Now, you can say that if we go here more, I'll talk about the decline rates on the Frobishers here a little bit later on, but just understand the fact that in 6 to 7 months, this thing has not only paid out once, it's paid out 2.5 times. Everything else from now on is just complete gravy, both in production and cash flow. Vermilion also has Midale wells that are coming on really strong. So 250 barrels per day, similar, very, very cheap to drill. And this one does look to have declined a little bit, but we'll see whether it rebounds or it stays here moving forward. And you can see how Vermilion's drilling these wells. The underneath dot is a Frobisher and the top is a Midale. So in the same area, they're hitting multiple zones, which is bringing them really good results. And now they have double the acreage. When you look at it, like, okay, they got this much acres, but both the Frobisher and the Midale are productive in these areas. They now effectively have double the acreage, which again is something you really have to see, and comes back to the bypassed pay comment. Is there's bypassed pay all across these areas that is now being targeted, of course, as long as it's economic and productive. Surge has some wells in the Frobisher here, 350 barrels per day, month 1 production, looking very good here. We'll track these as we go on. Anova is another private company in the Frobisher. Very, very cool company here, run by a very strong geologic and engineering background team. So not surprised that they're having a lot of success. 400 plus barrels per day. Rock Resources not doing as good so far. So they are hitting some good wells, but they are also hitting some duds. So this well came on at about 20 to 30 barrels per day, but 450 of water per day. So didn't look really good here, unfortunately, but they do also have a lot of acreage still that they can keep producing. And all you need is one, like you don't need to hit every well in the Frobisher to get the economics of continuing to drill. As I mentioned, the other well paid out 2.5 times in 6 to 7 months. So if you have a 60, 70, 80% success rate on these, it's still very economic, even in an $80 oil environment, to be producing these. Here's another well from Rock that actually did end up doing well, a little bit older well. And this one actually, I think, ended up making Saskatchewan top wells list at the time. But you can see the decline rates on these Frobishers. Some wells that are really strong, they get a double whammy impact because they don't seem to decline as fast. So you really want companies that are hitting 2, 3, 4, 500 barrel per day Frobisher wells and get the outsized, very juicy impact from that. So this one came down to 50 barrels per day in about 9 months, and now it's going to stay here. Whereas this Vermilion well, 6 to 7 months in, it's still producing more than 550 barrels per day. Okay, a little bit more. I'll talk about Southeast Saskatchewan more once we're in the surge part of the presentation. I'll talk about some more of the results. I think I got quite a few in there. So for now, watch companies that are in the Frobisher. It's very economic, very good production, light oil, super cheap to drill, and the netbacks are just fantastic because the royalties are so good and the operating costs are so low. It just makes sense. I believe, if I'm not mistaken, the netback at $80 WTI is still in the range of 65 plus Canadian per barrel. So at $100 WTI, now we're talking about $80 to $85 netbacks per barrel. Very, very good. Here's a new company, Suede. They came in the Ellerslie area. They were going to run some sort of very exploratory growth model, and that's what they've done. So look at this. This entire area was filled with gas wells, which are this symbol here, the circle with the spikes around it. That's a gas well, filled with gas wells. They came back, they found the bypass pay that I've been talking about, and they drilled 250 to 400 barrel per day oil wells. Simple as that. All this information is public. All the information can be accessed by anybody. You can go there, grab whatever you want. The Alberta Core Lab is completely accessible to whoever wants to go and look at cores. It's all there, and it's just who does it, who finds the acreage attractive enough, who can find the capital, and who can go and drill these wells. So very nice wells here. We'll see if they have delineated just a small pool or they've actually found something a lot bigger here. You can see these are 1 mile lateral wells. Look at this well here, the one with the blank, just a circle there, a blank circle. That means the well is being drilled or has been permitted as we speak. These are now longer wells, 1.5 mile long wells. So you're seeing a company, a private growth company, do what a private growth company does. Find acreage, buy land, drill shorter horizontals to make sure the area is productive. And now we move into full-scale field development. Longer laterals, hopefully better economics, and hopefully better well results per lateral foot. Okay. Kiwetinock, this is in the Duvernay. So this is another new company that came up about last year sometime, focused on the Duvernay. They're also focused on some renewable projects and power gen projects. Nice little well, 10 to 11 to 12 MMCF per day. We don't have condensate numbers because they don't put it back to the well level. Hopefully this is going to change as time goes on. But so far, looking pretty decent. And then look at the decline on this. So we'll see how this pans out here. So Kiwetinock is a very high growth, aggressive company. They got the founder, Pat Carlson, was the one who founded 7 Generations, ran that very aggressive model, but you needed the geology to back it up. So we'll see now, has he hit the sweet spot twice, or is he dealing with maybe a less prolific acreage here? this time around. I do want to make a quick reminder, anybody on the Twitter space that would like to join for the Zoom session, whitetundra.ca. If you scroll to the bottom under events, the Zoom link is on there, and you can join us for the visuals as well. I3 in the flare, so not looking too great, but a nice gas well here, about 450 to 500 BOEs per day of gas hanging in there. The oil rate, not bad, 40 to 60 barrels per day. Cheaper wells. I3 is targeting some bypass zones. They're targeting some fringe areas. They obviously bought this asset very, very cheap. So for them, it's just about maximizing production and cash flow from here onwards. And looks like they have a few different wells in place. Some are more gassy, some are more liquids rich, and then some are your oil wells also that they're focusing on. So nothing so far that's really excites me, but also they haven't really hit any duds. So everything they hit is at or above type curve, drilling pretty decent wells at a relatively good price. And the company itself trades at such a low multiple that for them to keep increasing production, I mean, it may not make sense, but they are doing that. And they seem to be doing a pretty good job at keeping really good production numbers going. I3 in the Montney, this is where they've hit actually a really good well last year. So they hit this one in the Simonette part of the Montney, and about 9 months later, it's still producing 450 barrels per day, really good. The gas rate is another 200 plus BOEs per day. And on this specific Montney well, it's not that this well is really good. It's the fact that they have a lot of acreage around this land, both from the Montney perspective and from royalty land perspective. So they own a few sections of land that they themselves own, and then they've got a few sections on which they own royalties. So I think it's a pretty good setup here. We'll see how aggressive they are with targeting this. You don't really want to blow through all your good inventory if you're looking for a sale or at some point looking to exit. At the same time, if they do need one or two more wells, they have the capacity to do so in that area. Here is one of the newer Montney wells. Not as good, but still pretty decent. So we'll continue to track their Montney, see how it goes going forward, and what kind of results they get, because this really can become a cash flow and production growth area for them, especially if they're looking to expand in the Simonette, where there is still some open land where you don't have infrastructure and can be bought and produced / developed in this cycle. Okay, so there's a question here. How would you say your update of Cardium, Montney, and Simonette impacts your impression of I3? I mean, nothing really has changed. I've always owned I3, not just for the fact that it trades at one of the lowest valuations in the Canadian oil and gas space, but also because I believe in their geology team. So their ability to find sweet spots based on looking at well results, looking at logs, looking at geology, pores, etc., is really, really good. So if you're betting on a company that wants to grow production through the cycle and is not going to hit bad wells, they're not going to screw up on their operations, and they're going to continue to grow production, they do have the assets and they have been backing that up. Like when I say I'm not seeing anything completely out of the park with I3, I don't mean that in a negative way. I mean that to say that a lot of the wells that are worth discussing a lot of the time are the ones that are home runs and grand slams. But if a company can just produce at or above type curve on every single well on acreage they got for super cheap, I mean, there's nothing wrong with that, especially when they trade at super cheap valuations. So continual execution of the plan, basically. So I talked about the lower Cardium. Now let's talk about the Viking. Some of the changes in the Viking that have been happening. You never saw Viking well results like this, 200 plus barrels per day, let alone 275 approaching 300 barrels per day. And looks like Whitecap has hit one here. You can see how they've drilled this well in the middle of all their acreage. It's a lot longer, maybe 30 to 40% longer than their other Viking wells. But overall, really good results out of very cheap wells. These Viking wells are 1.3 million, 1.5 million dollars, and you're getting good results right off the bat. And on an infill to boot, it's not even on a fresh acreage. It's on an area where they already had a bunch of Viking wells right next to it. So infill drilling, why do I think this is the lower Viking without having looked at the logs or the drilling sheets or anything? Because they have an infill well that's producing this much. So they've gone into the other part of the OOIP on their acreage and started producing this. Definitely watch for this going forward. Some of these areas, Cardium and Viking, have like basin production has been declining for many years. Could we see a resurgence, especially in a higher oil price environment, to these acreages? Journey as well in the Viking, some really good wells, 300 plus barrels per day, and declining though. Any Viking well is going to decline at this sort of fashion, but the fact that they start off at 3 times the rate to begin with is just fantastic. Where are we here? Okay, Obsidian Viking, same thing. Looking at really good wells here, 200 plus barrels per day in certain cases, and on its typical sort of decline. All these companies are doing fantastic. It's just a great time for them. They are able to grow production, get really good netbacks, and do a resurgence on areas that were kind of dead. It was like, oh, this is just going to decline forever, and there's not much upside here. Now there is upside in the same areas. Another Whitecap hit. So not only have they been doing really well in the Cardium and the Viking, their Glock acreage is looking really good. So wells over 1,000 barrels per day came down to 500-600 barrels per day a year down the road. This is a relatively new area, so I don't have enough well results here to make any sort of significant conclusion. But so far looking quite good, and we'll see what they do. Whitecap does have a lot of acreage all over the place, so we'll see if they can get their conventional side and some of their older, call it legacy production up to also supplant what they're doing in the Montney and with their other major acreages. Once again, the unfortunate part is it's stuck within Whitecap. The company is just too big for some of these things to really matter or be worth discussing. But I still think from a geologic perspective, it is interesting, and other companies next to them might be the ones to watch. Other smaller companies around them with similar acreage might be the ones to watch. Here is a older glauconitic well. So you can see Whitecap has had this acreage for many years. Assuming they didn't buy this, but they have had this acreage for a long time. You can see the decline rates on these wells. But when you start off at 200 barrels per day versus 1,000 barrels per day, you get way more production and way more netback out of these wells and a way better NPV. So it's not that the zones are new, it's that the drilling and fracking and the overall geosteering technology is just way better, and companies can finally use it in a higher oil price environment. So I keep repeating this point. It's not that we don't have the oil. It's that companies in Canada just never had that green light to go and do these sorts of things until maybe last year. It may again be on pause here for a little bit, and then we'll restart some of these activities. So keep an eye for which companies own this kind of acreage, and also undeveloped acreage, plus acreage with bypass pay going forward. So I'll kind of come back to this point again as the presentation continues. But when I say that asset retirement obligations is not necessarily a negative, and it's definitely not a negative to the to the level that some people make it seem, I truly mean it, because companies that have old acreage with 10 wells there, and you think about, oh, I'll have to abandon this and it's a mess, you might end up drilling 1,000+ barrel per day well on that acreage because you own the land already, you own the infrastructure already, you have access to the best production data in that area, and you can go back into your older wells and maybe re-drill a sidetrack. You could do a refrac. You could go and core them again. You could do some wireline work, do some logging. So asset retirement obligations, don't just think of them as a complete negative. That means the company has a lot of acreage and wells everywhere, which can benefit from new technology and new drilling and new optimization. Looking at everything in a pessimistic lens is just not the right way to think about these things, especially not in a structural bull cycle when a lot of things become economic that maybe weren't economic in a $50 oil price environment. One example of that, Prairie Provident and their Coots acreage, which is right next to the border, the Alberta-US border, they restarted some wells that were shut in for over a decade. So these wells have been down since 2009. You can see when they went down, they were still producing 5, 6, 7 barrels per day. So what happened? Well, in 2010 to 2014, it's not that the wells weren't economic, it's just nobody cared. When you could go and drill new wells that would produce way more barrels, it made sense to put your engineering teams and your drilling rigs and your workover rigs towards new wells and produce this like growth company mindset. And then 2014 to 2020, the wells did not be economic. The wells were not economic in that environment. So what happened? You had 10 years, two completely different environments, yet the same wells were just shut in. In the first 5 years, because everything else was better and they wanted production growth, so they stopped caring about these piddly little wells. In the latter 5 years, because the wells were just not economic. Now we're in a new environment where nobody really wants to grow all that much. They're not interested in drilling unnecessarily. And also prices are high enough that these wells are economic. So what do you see happening is companies are bringing on these wells because they've been offline for a decade. They come on at a rate that's 3 to 4x the rate they end up stabilizing at. And even the rate they end up stabilizing at is 50 to 100% more than the rate when they were shut in. Some companies have hundreds, maybe thousands of wells like this. All you got to figure out is which companies have enough wells that it can really increase their production in a very capital efficient manner, and then go and invest in them. So go and invest in them if you choose. By no means am I saying that that's what you should do, but this is a well that shows up as asset retirement obligation. That's it. Unless you're willing to put in the work and look at these wells and see what the upside is, it will never make sense to you. So that's why I actually like investing in companies with asset retirement obligations, and I get a second bonus because they are traded so much cheaper than companies with low ARO. Here's an example that's in Crescent Point. So unfortunately, Crescent Point may be too big for it to be worth investing in just for its reactivations. But you can see the point I'm trying to give here. They've got all these wells in Coots, same area, same exact area Coots, that are suspended. Not a single one of them is producing today as we speak. And somebody looks at this and they go, oh, that's $2 million of asset retirement obligations. That's all that is. And they say, not interested in these companies. Okay. This Coots asset was producing 250 to 300 barrels per day 10 years ago. What happened? Your well count started dropping for the exact reasons that I just mentioned. The first 5 years and then the next 5 years, production started dropping. Crescent Point doesn't care about 200 barrels per day out of 40 wells. They got better stuff to do. They got wells in the Duvernay that'll produce 1,000 plus BOEs per day each. So they put their engineers there. They put their geologists there. They put their finance people on those assets. And this thing just sits here with nothing happening. Well, this pool can still produce 100 to 200 barrels per day. All it needs is these suspended wells to get reactivated, put a little bit of TLC on them, and your asset retirement obligation, which is a complete negative, now became a 100 barrel per day producing asset. And what's 100 barrels per day producing worth? 3 million, 4 million, 5 million, just sitting there. This is one example in one big company of what asset retirement obligations get seen as and what the actual opportunity is in an actual bull cycle. So just keep this in mind. Not necessarily true for every company, but I can provide you many fields that in a higher oil price environment will get brought back. It's just about in which companies do they actually matter, and in which companies is it just, piddly few hundred barrels here or there. Similarly, injection volumes. So companies that have mismanaged their injection volumes, which is what happened to the previous owner of Prospera, they just kept injecting more and more water. The prevalent narrative is if we have a water injection or water flood, the more water you inject, the more oil we should get out. No, that's not how reservoir management works. That's not how production engineering works. So Prospera bought this asset. They immediately lowered the injection volume. When you have too much injection volume, you're just bypassing the oil with too much pressure. You're not pulling that oil with you. You're not allowing it to get off the rock and come into your emulsion stream. And you're effectively just recycling water. As we see more and more companies, smaller companies, look at these older pools and they do a little bit of reservoir analysis, they do some management, you will see better production simply by, let alone restarting wells, better production and better operating efficiencies simply by doing a better job understanding what enhanced oil recovery scheme you're in, where is the oil being pushed towards, can we lower injection here and increase injection here, can we convert this oil well to a injector and convert this other injector to a producer. So simple little things that just have not gotten the right time of day over the last 5 or 6 years. Okay, so there's a question here: are you out of restriction on PPR? No, not yet. No. So I can share individual wells and what happened because it's all public knowledge, but I cannot speak, unfortunately, in detail on anything just yet. So there's another question here. Do you got shares in all these companies? Yeah, I can talk about this at the end in the Q&A portion. So give me a few more minutes here, get through the wells, and then I'll discuss some of these questions in the Q&A part there. So once again, I just threw this in there, not because these are wells that are all that important, but I do think it's worth discussing because I hear a lot of misinformation on older wells and, oh, that's just all complete junk. It'll never be restarted. How do you know? Have you gone to those wells and done a deep analysis? Have you looked at the reservoir analysis? Have you done the production optimization work? Most people have not done any work and just saying things for the sake of having an opinion on things, which more so apply in a $50 oil environment, not in a structural bull oil environment. Rubellite, Figure Lake. This is a Clearwater well that Rubellite drilled. Did not pan out. The reason I share this, not to bash on Rubellite, is to show you that exploration and development is not a 100% game by any means. So when you look at certain companies with good acreage, they're drilling really good wells like Baytex, Peavine, and now all of a sudden the results are 200 barrels per day less than what they were a year ago. And I see people getting a bit negative. By no means is a 600 barrel per day well a given? And by no means is it uneconomic. By no means is it a bad drill. Things are still really, really good in companies that have the acreage, because there's other companies that would dream and wish to have that acreage that these companies do. So Clearwater especially has been kind of a hit and miss game here over the last few months, and companies are failing to hit stuff pretty consistently. Honestly, there's been a lot of failures to hit oil in the Clearwater in the last few months. So just keep that in mind. Always have a relative view of your wells, not just an absolute view, and always have the absolute view as well, not just a relative view. So there are companies with really good acreage. There's companies that are drilling maybe wells that are below type curve, but are still wells that pay out in 8 to 12 months in a $75 oil environment, wells that pay out in sub 6 months in a $90, $100 oil environment. Lots of potential here still. Clearwater is still very young, still very new. A lot of new technologies are coming up. We're going to continue to see better results due to that as time goes on. Here's Rubelite in Dawson, 65, 70 barrels per day. Decent well. Definitely not a usual Clearwater. When people think about it, they want 200, 300, 400 barrel per day wells. It doesn't always happen. So once again, just keep that in mind. The Clearwater is by no means a given. There is a lot of delineation still going on, a lot of work still going on. We'll kind of track things here as we go and expect to see better and better results as time goes on, because you'll see some of the poorer acreages being completely removed, and then some of the technologies getting better on drilling muds and geosteering, and even possibly some viscosity reduction techniques that come online as the Clearwater continues here downhole, whether it's solvent washes or similar chemical stimulation, could be very interesting going forward. Here's some of Surge wells in the Frobisher, 225 barrels per day here. We got this one that's 325. We got this older one that came on at 275 and then actually went up to almost 375 in month 2. These wells are sub 3-month payouts at $80 oil. At $100 oil, they are maybe sub 10-week payouts, maybe 2.5 months or less payouts. And then they do decline, but you will get a second payout within 6 months, and you will get a third payout within a year. And then they just continue on and on like that, in that similar fashion as things sort of go on. So even though they have a high decline, when your well pays out 3 times in the first year, how can you speak negatively about that, right? So just take everything that people are putting out there with a grain of salt. Oh, this well is a high decline. It's not actually a real well. When I put $1 in and somebody gave me $3 back within a year, am I really complaining what my rest of my payback looks like? Yeah, maybe, but I'm still very happy and very positive, especially when I got hundreds of these opportunities to drill these 1 to 3 wells. And I'm getting more and more as we speak. So everything, just keep all of that in mind. Here's one of Surge's wells that actually didn't pan out all that great. So even though it paid out in the first few months, it didn't really end up sustaining that slower decline. It just fell off a cliff. This is the way some Frobisher wells are. This is the pools. They're very tiny pools and very productive, tiny little pools. You need to do a lot of geologic work to find them. But once you find them, you make a lot of money on them all year long. So very nice. Even this well with this catastrophic looking decline rate would have paid out in 3 months. And it's still producing 75 to 80 barrels per day. So it's still making that base production as time goes on. Let's not forget 80 barrels per day is like a really good Viking well from 5, 7, 10 years ago. So everything in relativity. Surge and the Sparky also doing pretty good. a 175 barrel per day well here that just came online. So they are continuing to drill really, really good Sparky wells. Here's an older well. So this is the multilateral here. So I want to get into a little bit of discussion on development and what's changing. So Surge has these fracked wells, 4 fracked wells that they drilled late last year. Q3 to Q4 last year, they brought them online. They bought this multilateral well from Westlake. And now they just drilled these 4 more wells over here that just came online a month or 2 ago. This is the production on the multilateral well. Came up, declined, and then it jumped from 30 barrels per day to 100 barrels per day when they fracked these top 4 Sparkies. And then it declined again, and then it jumped again when they fracked these bottom 4 Sparkies. Not only that, these fracked wells never had any sort of problem in production. It's not because this multilateral was here that these fracked wells suffered some sort of production problem. They all produced like a Sparky well would produce. So the hint here that I'm trying to throw out is there's a future development potential in place where you drill multilaterals between fracked Sparky wells and you get a double impact and get way more production out of that one section of land than you would with simply multilaterals or simply fracked wells. So a lot of science going on. The results are not clear right off the bat. You need 4, 6, 7, 12 months to prove these things out. And that's exactly what Surge is doing here. They didn't need to buy this Westlake well, but they did. And you can see why. Because they knew when they fracked these Sparkies, the multilateral production was also going to go up. So a lot of technology still to come, a lot of development planning yet to come as to how exactly they space these wells, how exactly they put which wells where. It's not as simple as just going and cookie cutter drilling anymore. There is new different mechanisms and ways to do things here that maybe nobody really ever thought about or talked about earlier. Okay, so where can publicly available well information be found? So all information will be on PetroNinja. PetroNinja is the Alberta's portal for all the well information and facility information. And then the user-friendly way to find it, which is what we're discussing today, is on PetroNinja.com. So they will have the graphs and all the information preloaded in there, but you can actually go to PetroNinja for free and get all the information yourself and build your own Power BIs or graphs, whatever you want. It's all free for everybody who wants to use it. Okay, so this is one of the newer fracked Sparkies. You can see it's still doing pretty good. These are the other ones, still doing that 90, 100, 120 barrels per day. We also have a new Sparky. So when I talk about Surge, obviously it's my biggest holding, my biggest position when you combine the White Tundra portfolio and my personal portfolio. And why am I so bullish? I keep getting this question. Why are you so bullish? What's going on? The reserves are not that much greater than anybody else. It's because of undeveloped land. So this is a new well close to Wainwright, close to the Wainwright Sparky pool, in the middle of nowhere. There's no other wells in this area. And you get a typical Sparky production. So there is so much undeveloped land that Surge has that they know has the same Sparky characteristics, same logs, the same productive capacity. They just haven't got to it yet. Therefore, it doesn't show up in reserves. It just shows up as undeveloped land. Once they drill this one well, they will get some reserves in this area for it. But this pool could be multi-section wide pool, right? A multi-section wide Sparky pool. And you're seeing the first well they hit, well, the first well they drilled has come on just slightly below your typical Sparky type curve or your typical Sparky peer production. What does it tell you going forward as they delineate more of these wells? They get better at Sparky production, better at figuring out how to drill these wells, what the perfect production patterns are. and then they go and use those on all their undeveloped land. Many companies have this. This is not, Surge is particularly in the Sparky has this. Many other companies have similar upside in other zones, whether it's the Viking, the Montney, Glauconite, the Pekisco, the Manville, Artium. I like companies like this with undeveloped land that they can now use newer technologies on, better well productivity on, and they're at this point today getting zero value or zero credit for it. Now, this is obviously a longer term layout. This is not going to be that they drill 5 wells today, production jacks up, and it's reflected in the share price. This is going to be more of a slow burn, a growth story. There's no point drilling these wells in a sub $80, $90, $100 oil environment. We'll just save it. We'll save it for when prices are really high. We'll delineate it. We can either keep producing it or we can sell it with all this inventory still in place once you proved it out with 5, 6, 7, 10 wells. And very cheap. These wells are 1.2 to 1.4 million, same thing, very cheap. And you can prove out very large quantities of oil and reserves and production. Surge also has the carbonate acreage up north. So this is the EV red earth area, and very nice wells, 250 plus, well, 200 plus barrels per day. They decline. These last wells were drilled in 2018, 2019. This is actually a Prairie Provident well here, right next to where Surge just licensed 2 wells in this area, in the EV red earth carbonate play, and not yet drilled, but licensed. So when we talk about wells to watch, these 2 wells are, in my opinion, very important to watch, especially if you're a Surge investor, but even if you're an investor in any company in this area, because this area is a higher operating cost area. It doesn't compete for capital at lower prices. As prices get higher, it really competes for capital, especially because the infrastructure here is very unused. So there's a lot of synergies from increasing production in this area. This is what Surge bought in 2018, 320 million they spent on it. It was a core area at that point, light oil. You can read kind of things here. 600 million of oil in place, only a 6.6% recovery factor. Some of it is not even on a water flood yet. It's a structural reef buildup, a higher quality compared to the Slave Point carbonate platform. 22 meters pay thickness, 15% porosity, and 100 millidarcy of permeability, which is getting very close to your Manville group, 1 order of magnitude lower, but still very, very good production, or very, very good porosity, permeability, pay thickness, and low recovery factor. So on top of individual wells being brought online in certain places, keep an eye out for companies that have core areas that just have not competed for capital in a sub $60 oil environment. Now that things are getting to a higher and higher price and a higher floor, along with a higher, obviously the higher a top where prices can go to, some of these pools are now going to start to get capital injected into them, not only with new technology, but with hundreds of millions of barrels of oil in place. So again, this is not just Surge. I picked Surge to share these examples because I know the company the best out of all the companies that I own. So I just have a more better understanding that I can give the examples in the proper way. Other companies have the same sort of opportunities. So whether it's companies with acreage, whether it's companies with mineral rights, whether it's companies with high original oil in place pools that they just haven't had a chance to really produce and delineate, the same point applies. Watch for this going forward. And some of these wells, not just with Surge, but with other companies, will end up on my PetroNinja wells update as time goes on. So you'll see it show up as we see more and more of these areas getting delineated and then reproduced. So there's a couple of questions here. Yeah, Pipestone is the exact same. Pipestone in the Montney is the exact same as what I'm describing here. It's the same exact thing. In fact, many Montney companies have the same undeveloped land that doesn't show up in production, it doesn't show up in reserves, and they get no credit for it, yet we know it's in that Montney core trend. So, I mean, that's up to you now to decide how much value you want to give it. But either way, the value is going to get proven in a structural bull market, structural oil bull market, no matter what. So there's a question here, why did they not drill in this area? Because it just doesn't compete for capital. Their Sparky and their Frobisher is so good that this area just has not competed for capital, especially because when you want to drill some of these carbonates and reefs and whatnot, you likely want a major drill program like 7, 10, 15, 20 wells. So they just haven't had the money to do that kind of excessive drilling. It's just cheaper. Once you get a rig up there, you might as well keep it going all summer or all year and just keep it going rather than get it up there for 2 wells, pay all this money, and then send the rig back, pay for the rig, move up and down. It just doesn't make sense. Okay. So there's a few other questions here. I'm going to save them for once I finish the presentation, and then I'll scroll up again and get to them. The one I will answer right now is will Surge up its dividend? So I don't want Surge to up its dividend anymore. It's now up to that 5.5–6% range, which I think is competing with any of their peers. We don't need to get to a 10–12% dividend. And the reason I say that is because what are you going to do with the money? What exactly are you going to do with the money? Do you think that dollar that they give back to you, and I don't mean this in a rude way, I just mean this to think about this. That dollar that they give you, do you think you can generate more somewhere else than what the Surge management can do with their assets and with the production profiles? If the answer is yes, why are you in Surge to begin with in the first place? And if the answer is no, then we want a dividend that's meaningful, that's sustained, that can be used to get new investors into the name, but we don't want an egregious dividend that reduces management's ability to actually go and delineate these assets and generate value for you. So maybe not exactly the question you asked, but I do think pushing for higher and higher and higher dividends is just not a good way to own these companies, especially companies like Surge that have a lot of undrilled areas, undeveloped land, and a lot of opportunity to make more with that dollar than like a high or not a high decline company, but then a company that has very limited inventory. For them, okay, if you want to pay out these dividends, go for it, because you can't really use it for anything else in the short term or the midterm. This one was interesting. Crovero is a private company. They drilled 1 well in the Sparky, and they had a gold company that came in for 37.5% of that well. Pretty interesting to begin with. And also, they said their share of production was going to be 55 to 70 barrels per day. So far, it's looking like this well has not panned out. It's only the first month, very, very, very early. But I'm just tracking this for more of curiosity as to why a public gold company would go and invest and be a farming partner on a Sparky play in the oil field. So just cool things that come up when I'm doing my well reviews, and I look at well updates, the latest wells that got drilled, the latest wells that got permitted. There's some very cool things that you see would just catch you off guard. And I'm curious to see how this relationship builds between these two companies as time goes on. Perpetual Energy is another one with some really nice Sparky acreage, mostly multilateral out by the town of Manville, 300 plus barrels per day out of multilaterals. Very nice. Nice decline rate right off the bat, but then it does flatline. It has flatlined at about 175 barrels per day for 4 months. So a lot of oil in place here. And I will also continue to track this. Why do I share this? Because Perpetual is a very small company. So if they can hit 10, 15, 20 of these wells, their cash flow could end up going up significantly with very little capital cost overall. Baytex. Baytex just announced a discovery on their Q1 conference call. It kind of got missed by a few people, I think. So I'm going to share this. It is a discovery just north of Edmonton in the Moranville area. And it is a multilateral clear water well, 180 barrels per day. And not the full scale clear water development. It's a smaller laterals on it, about half a mile to 3/4 of a mile. So 180 barrels per day, pretty good. We'll see how this pans out as time goes on, but the clear water is by no means done, and lots more areas to find, lots of enhanced oil recovery, water flooding, maybe polymer at some point to do. Let's not count these companies out because 2 or 3 wells didn't pan out or the production was dropping. If you are investing in the Clearwater, you have to realize you're investing in the acreage and what it has and the company's ability to produce that oil as the cycle goes on. We're not investing in today. We're investing in what this field can become. And the question becomes, are the valuations already reflecting that or are they not? I would argue in some companies, they already reflect a very high Clearwater growth rate in the equity price. Some companies, they don't. And that's what makes market, depending on what people think does and what doesn't. So once again, look at this land and take this Clearwater well out just for a second. Take it out of the picture. And what do you see? Most people will say asset retirement obligation junk. That's exactly what they would say. And Baytex is one that has a lot of these sorts of heavy oil areas, tiny little pools all over the place that they've just kept. They've abandoned a few wells. They've kept a couple producing, 1 or 2 suspended, tiny little pools. And now they've found a really nice Clearwater well in this area. Here is an older well, this producing well right here, the one, the black dot. It's been producing since 1961. And so what is that, 60 plus years, 65 years this well has been producing. It's still making something like 5 to 10 barrels per day. I don't know the exact number, it's too zoomed out, unfortunately, but still making 5 to 10 barrels per day. What does that tell you about the productivity of the formations in this area? What does it also tell you about bypass pay in the area? When you have these sorts of acreages, you can give it to your technical team and say, hey, find bypass pay in this area. And that's exactly what they did. So I've got a lot of pushback on my comments saying that asset retirement obligations is not only not a negative, it could potentially be a positive. And here's the third example today I'm sharing of companies that are doing that, doing exactly that, using asset retirement obligations, which strictly means they have more wells and more land. That's literally what it means. And making a lot of money out of these, and the cycle is only just beginning. Here's Crescent Point in the Bakken. So Crescent Point in the Bakken had these very decently spaced Bakken wells that they produced a lot over the last 20, 30, 40 years. What have they done now? They're converting all their producers into injectors. This is your injector symbol. This is your producer symbol. They're converting the existing producers into injectors. So think about all the oil was coming into these producers. It was being produced, but then there's oil that got left behind on the sides and then near the producer somewhere. What they're doing, they converted that producer to an injector, and then they drill 2 producers on each side of that injector. Makes such simple sense. You now are injecting water into a low pressure area, pushing it into high pressure area into your two production wells on each side. On top of that, they're doing infill drilling between the 2 wells. So it's going to be hard for anybody on Twitter to visualize this, but you can see what I'm saying if you look at the picture right here. So they converted these, they drilled 2 producers on the edges, and then where the toe of the production and injection wells are, they drilled a well at a 90-degree angle to that, right in the center of that, that's now producing a lot of barrels on its own. 200 plus barrels from this one well in the center, let alone all the production benefit from the wells on the side. As simple as that, Crescent Point has hundreds of thousands of acres in the Bakken, with a lot of it that hasn't gone on this new production profile yet. Look at this section right here, still to be done. This section right here, still to be done. All of these still to be done. So old assets don't just mean that you can just decline them forever. Yes, some assets have no future. You just got to decline them, and there's not much you can do. But with the newer technologies we're seeing, a lot of these, well, not a lot, some of these older fields are seeing a renewed life, and that renewed life is looking very youthful and very productive and very economic. So watch for this in the bigger companies. They have a little bit more of the engineering and technical teams to do these things, but also some of the smaller new companies that are popping up. And what exactly are they targeting? Just by looking at the acreage, you would say, this is old legacy decline stuff. We don't want it. Well, Crescent Point said, okay, we'll keep it, and we'll make a lot more oil out of it. This also applies, doesn't really apply to other companies in the Bakken so far, because I'm not seeing them doing this or be as active, but we'll see as time goes on who else starts copying this model. And then here we have the multilaterals in the Bakken that Crescent Point has been trying. They started with 2, now they're up to 4 or 5 of them, and they're all looking really good. About 250 to 275 barrels per day. This one was 225. It still declines like a Bakken sandstone sort of well, but it's on the fringe. You're producing Bakken, not from the core. You're now producing from the fringe at these sorts of levels. Really good, really, really good. Here's the one that Cache Island first drilled. So before Crescent Point even got to the scene, Cache Island, which is Scott Saxberg's new company, Scott Saxberg being the ex-CEO of Crescent Point, he came in, he drilled these wells, 150 barrels per day. This other one didn't really pan out, but still quite good for being fringe Bakken. And Crescent Point said, thank you so much. We actually have the best acreage here, and you have delineated this technology for us. We're now going to go and start producing way better wells at this. And that's exactly what they're doing. So very early stage, keep your eye out on this multilaterals in the Bakken, which is looking quite productive thus far. The other new design we have is the fishbone that Lycos has been using. So they started off with a multilateral here on the left, came on at about 70, 80, 90 barrels per day. Nice little decline on it. This is the Sparky formation. And pretty good for multilateral. Nice little production, cheap to drill. They had a few different legs of different lengths, and then they moved to the fishbone, and the fishbone is even better. So 60 to 70% better IP90 on it in terms of total oil produced or rate within those 3 months, and it's only just beginning. This was a first fishbone design. They now have the second design, and this third design with some short legs and some long legs to access every single part of the reservoir, no matter how thin it is, and no matter how small the width of that reservoir is itself. So looking quite good. Following this company pretty closely, a very high growth, aggressive company. If they can continue to drill really, really, really good wells, maybe the valuation does end up making sense. At this point, it does trade at a premium, but as time goes on, we'll see if they can really delineate this new technology. And also, who else is in the Sparky that can use this fishbone design? I think you know the answer. So I think, I don't know how many more slides I have, but I've got a few more, and then we'll get to the Q&A as well. Probably a pretty short Q&A today as well, but I think we've covered a few different topics here this time. I think the last PetroNinja wells update was strictly well. This time I wanted to go more into overall wells, not just new wells, but what am I seeing on the optimization front and the restart front, these suspended wells that are coming back, along with any sort of new designs and new technology as well that's coming up. So here is a well that Razor drilled in the K-Bob area and drilled it in a formation that already had something like 30% recovery factor. Well came on sporadically, was shut in, and now it's back online. So when you look at company-wide production, you do want to look at wells that got shut in without reason. So wells in 2019 that went offline, any well that went offline from 2015 to 2019 has a pretty good chance of coming back online in a higher oil price environment. So certain companies obviously have a lot more of these, Razor being one of them. So these wells went on offline. Razor didn't really have the money to do any workovers or reactivations. Now they do. And now these wells have come online at 20 to 30 barrels per day each, and they just stay there, owing to the low decline nature of these reef-like acreage and the reef-like geologic deposition that happens. There's other wells in the Virginia Hills that are the exact same. So they got shut in 2020, and look at the decline rates on these. Once you decline off the top in these reefs, any reef that's in conventional North America, so the Leduc Reef, obviously the Swan Hills reefs are the most common and the most known. Once they decline to a certain rate, they just stay there forever. So you want to look for wells like this that can come online, that companies can bring online, that produce a lot of oil, and then they don't decline, because your cash flow jumps up substantially when your company has a lot of these wells. Some of these wells, you can see, they've produced for 60 years. The exact same thing I was describing earlier, that there's so much oil in the ground here. It's just about, is it economic enough to produce? And does the company that owns these wells think that it's worth their time to produce these small little wells all over the place? So very similar. This well, for example, has been offline since 2011. But when it went offline, it was producing 20 barrels per day. In a $50 oil environment, would you do a workover on that? No. In an $80 to $100 per barrel oil environment, would you do a workover on that? Possibly. I guess we'll find out. And same thing, I can go through these wells all day long. These reef patterns have so much oil in place and so many wells that you could just keep going on and on and on with different examples. I'm just showing you a few to kind of get the point across that when these wells went down, they were still producing 30, 40, 50 barrels per day. And these wells used to individually produce more than 2,000 barrels per day. What does that tell you about the reservoir productivity in this area? Another example, this one went down in 2014. Any well that went down after 2014 in a junior company likely has not come back online unless it's the top 10 or top 20% of wells to bring back online, and especially not in companies that had financial distress in the last few years. Here is the cumulative production of some of these wells right here on the left side, 7 million barrels out of one well. So when we talk about oil in place, I've been talking about this all seminar. The more oil in place you have, the better. The lower recovery factor, the better. But also the reservoir characteristics, how productive have the wells been, and what is the future upside with enhanced oil recovery or reactivations or restarts on these wells. When you have wells that have made 7 million barrels each, and your recovery factor is 35, 40%, now you want to do a CO2 flood or a water flood or drill some wells deeper. You can see the reservoir productivity on some of these wells. This is what the company is doing. They've effectively produced out of the top third of their reef platform. The bottom 2/3 of the reef platform still has very high residual oil saturation. So effectively, what I'm talking about is bypass pay. That's effectively what it is. It just hasn't been produced, and we'll see how things go here going forward. The company now finally has the money without being under this debt burden to go and capitalize some of these assets. And the oil is there. We have 60 to 70 years of not just well logs and well logs, production data, cores, etc. We have also had hundreds of SPE papers written on these kinds of reefs, because these are your hundreds of millions of barrels of oil in place, pools that some of the geologists and engineers and research analysts, meaning lab research analysts, would do their work on, because it was the most accessible and biggest apple on the tree in order to get the biggest apple on the tree to get your name out there, to produce a lot of oil, to get some new technologies implemented, et cetera, et cetera. So I'm pretty excited to see these reef plays and how they transform here moving forward in terms of the recovery factors that can be received. Obviously, a lot of oil still in place to get. Tamarack. So Tamarack Valley in the Nipissing is doing these multilaterals. Okay, there's a couple of questions here. I will get to all these questions in the Q&A section, so just hang tight. Tamarack in the Nipissing area, drilling really good wells. So as far as their Martin Hills has not really been panning out, I'll talk about this here a little bit later on, not panning out according to type curve, but also panning out just in general. The Nipissing area is doing really well. 250 to 275 barrel per day wells, stays there for 4 to 5 months. Here's another example, above 250, above 275 for 5 to 6 months. Here's another example. This one has a bit of a hard decline rate on it, but it did hit that 300 mark and then declining a little bit. We'll see how this goes. Does it keep falling or does it come back and rebound, especially if it's under water flood? Here's another well that's doing really good, 225, all in the Nipissing area. These wells are really, really good and very cheap to drill, solid production. Here's one that looks like it's under water flood. You can see the water injection trident pattern here. And look at the production increase every single month for the first 5 to 6 months. So some of the other Martin Hills wells that have not been coming online that strong, this well didn't come on that strong either. But under water flood, it really rocketed up and has stayed there for a few months now. Here's another one. Looks like it's under water flood as well. And then the water just takes time to come. It doesn't, on a water flood, the water doesn't come right away. It pushes the oil first, and then it breaks through at a certain point and starts coming up your production leg. Another well that just looks really good, 300 barrels per day. So the Nipissing area is good. We can kind of say for sure now that even the new wells are really panning out quite strong, as was expected, and even panning out above the rates that were sort of promised on the IP30 and under water flood. These wells may end up being better than the Baytex Peavine wells when you look at a 12, 18, and 24 month net back on the entire well, plus what it will produce as time goes on. Martin Hills, not so good so far. Certain wells, about 100 barrels per day. These are still really good clear water wells. These will still pay out in an $80 oil environment, I don't know, between 6 to 9 to 12 months, depending on what the decline rate on it is. You've got other wells that are 120, 150 barrels per day. These will pay out in about 6 months, $80 oil environment. Still really good wells. They're just not as good as maybe was predicted out of this acreage. We also don't know if everything is under water flood quite yet. So still waiting on more injection wells, more injection legs being put in to give us a better idea. And effectively, one of the things I want to talk about was load oil recovery. So along with the oil production, in certain areas in the Clearwater, for the first few months, you have to recover your load oil. And what does that mean? Certain companies will use oil-based drilling muds when they drill their wells. So what you're doing is injecting oil into the ground. You can't call that production oil. Once that comes out of the ground, you first have to recover all your load oil. You see here, even in Martin Hills, which they don't really use that much load oil here, you can see that there's a different graph just for load oil recovery that you have to add to your oil rate to tell you what the actual oil production rate was for that particular month. As that load oil is recovered, your overall well production should rise because you're no longer reporting that as load oil. You now can report it as your actual reservoir oil. So a lot of caveats here with the Clearwater. It's not as cut and dry as just looking at one well result or 20 well results and making a conclusion, especially wells with load oil, especially wells that are going to go under water flood as time goes on. And the reason why we use load oils is because certain water-based muds effectively swell the clay. So you can see how you have a reservoir opening of this size, but because you pumped in water with the wrong kinds of properties, it will swell the clay. So effectively will make it bigger and block off your permeability, potentially sealing off the entire channel that there was there, which is what has caused companies to move away from it in certain cases. Other problems with drilling mud. So just a bit of background. This is a science that is still being worked on in the Clearwater. It's not a fully 100% confident science yet. If you use the wrong drilling muds with the wrong contaminants and the wrong additives, you can have all these problems: stuck pipe, corrosion, instability, bit balling, kicks. You can take formation damage like clay swelling, emulsion, and aqueous filtrate blockage. So your oil can mix with the water in a strange fashion and block up your entire pore. So definitely a lot of things still being worked on top of drilling, completions, and well placement, etc. We're still working on the drilling muds to begin with, in terms of the best way to drill these Clearwater wells moving forward. The other Martin Hills wells, pretty good, 175. Here we have one that was 200 plus. So they are still drilling these 250 barrel per day IP wells. It's not that all of them are the lower ones. There's some that are lower, some that are medium, and some are meeting their own internal type curve, which I think is very aggressive. A IP30 250 in the Clearwater is a very, very aggressive type curve to be running right off the bat. Tamarack's Charlie Lake is also doing quite good. As I started the presentation off with Archer's Charlie Lake, this is Tamarack's Charlie Lake, about 11 to 1,200 barrels per day here. Cheaper drills. Tamarack bought into this acreage as well about year and a half ago, and getting some pretty good results. We'll see how they continue here, but they do have some of the best acreage in the areas they're in. So the Clearwater and then the Charlie Lake, they do have some of the top acreage in both those areas. Obsidian, after a few duds in the Blue Sky and the Clearwater, have come up with a banger. They've hit a 325 barrel per day month 2 production on one of their Blue Sky wells. The other well has hit 375 barrels per day. So 2 wells, very nice, very strong wells, and should be able to delineate this now further into more and more Blue Sky opportunities, which is the same way to drill the Blue Sky as you would the Clearwater. So multilaterals and a lot of aerial extent, and also a lot of oil per section where you can produce the Blue Sky. But obviously this came after a few bad drills. So we've got some wells here, Obsidian Blue Sky, 20, 30, 40 barrels per day. Once again, showing you why running off 1 or 2 or 5 wells is not the right way to look at the Blue Sky or the Clearwater. You almost have to look at it from a cycle standpoint. Okay, over the next 12, 18, 24, 36 months, what acreage in the Clearwater, if I want to bet on the Clearwater, what acreage do I want to bet on, and at what valuation? That's effectively the answer, the question you have to answer, not how is this well doing this month. Although it gives you an indication of how things are going, company could come out of nowhere and drill some massive wells as long as the acreage is right for it. And there's only a few companies out there that have the right acreage, not just to drill these kinds of wells, but then to have the number of acres to really make it a really juicy part of their company as the cycle continues. Here's one of their Blue Sky wells that got everybody excited in early 2022. Obsidian drilled one that started off month 1 at 425. Month 2 was 575. Month 3 was 625 barrels per day. So again, these wells are still pretty early. The 2 new ones are still pretty early in their production. This could be a 400, 500, 600 barrel per day well come next month. And this well ended up having a pretty decent decline on it, but not bad. A year down the road, we're still making 350 barrels per day on this blue sky well. And this well has cumulatively produced over 200,000 barrels in 1 year. So 200,000 barrels, $60 net back, let's say $60, $70 net back. This well has made $12 to $14 million of net back in 1 year on something that cost a couple $1,000,000 to drill. That's why these blue sky and Clearwater wells are so worth it for your company to keep drilling and keep trying, because all you need is one well to pay off a lot of mistakes. And that one well not only produces on its own, it potentially delineates 10, 20, 40, 80 locations for you with those sorts of metrics on them. And I once again say, find the ones with the right acreage to invest in through the cycle. Baytex also has some really good wells in the blue sky. So similar 400 to 500 barrels per day, still making 100 barrels today. And we're talking 6 years down the road, it's still making about 100 barrels per day. So really good. This well has cumed more than 350,000 barrels over 6 years. Once again, that's a $20 million net back, roughly, at today's pricing for something that cost a couple $1,000,000 to drill. CNRL also drilling some good wells at Smith in the Clearwater acres that they have. I don't really focus on this because to CNRL, it doesn't matter. I mean, a million BOE company, what's an extra 400, 500, 600 barrels per day? But they still do have some really good Clearwater acreage here that's sustaining very nicely. And, a lot of people may not know this, but this CNRL actually had 500 to 600 barrel per day wells already in 2021 in this Clearwater multilateral design. Baytex Peavine was just so good that it finally brought it on the map. But the Clearwater has been now a couple of years old, 2 to 3 years old at least. And possibly if you go back to Spur and Delta Stream and Crestwind, maybe even a little bit further behind there as far as its history. But the 400, 500, 600 barrel per day wells are relatively new, even in the Clearwater. And I'll end with 2 wells in the Rex. I think for those who have followed me for the last couple of years, you know why I was so bullish on the Rex in certain places, the Rex zone. And we have a couple of hits that have happened in the Rex in different parts of the Saskatchewan and Alberta area, the Provost, Macklin, Lloydminster area. This is a well from Cardinal. It's in the Chauvin area in the Rex. Came on at over 400 barrels per day. And even today, year and a half down the road, produces at about 300 barrels per day. So very nice. This well probably cost them $1 million, 1.1, maybe even cheaper than that, given that they drilled it in 2021. It has cumed, not entirely sure how much it's cumed, but hundreds of thousands of barrels here. And out of a $1 million drill, which is effectively what I was betting on with one of the private placements we did earlier last year. Westlake Rex, we're still following this well along. This was one of the best wells that was drilled in 2019 in terms of its net back NPV per cost sort of analysis. Same thing, cost about $1 million, maybe even less. And this well in about 4 years now has cumed 350,000 barrels. So very low royalties, almost zero royalties on these multilateral wells in the Manville group. So even at a $60, $70 net back on this, you made $20 million in 4 years of something that cost $1 million to drill. It's not just company maker wells. These are more than that. I don't know what the right term is, but you find an area like this and you're going to be swimming in money. Your company's going to be making so much cash and then can use it to go and do other things of that. So, I've got some questions on my previous private placements as to why I entered them, what the reasoning was, and here's the reasoning. This well, this Westlake Rex well is 5 to 10 miles to the west of the company that I'm talking about. So sometimes you take those shots and they don't work out, and sometimes we invest in more of a overall companies, which is what I tried to show through this presentation. Is there's so much upside through reactivations and new drilling and bypassed pay and reactivating suspended wells and refracs. Canada in general does not get the level of detail that the US does. There's not as many people looking. There's not as many people that are comfortable with the regulatory regime. There's not as many people who have the capital market support to go and do these projects. And it's finally good to see certain junior companies come back on the scene, and then certain junior companies pay off their debt through a restructuring or through a raise, and go and able to finally capitalize their assets in the right way moving forward. So I will leave it at that. Kind of discussed all kinds of topics today, including top wells, some of the new wells, some of the reactivations, some of the ARO wells, Montney, Cardium, Viking, some of the new technologies coming online, multilaterals, fish bones. And I once again want to say this is by no means a end all be all of the wells I track. It's just the ones that are interesting enough to share, especially because they cover a lot of different companies. So keep an eye out for this. PetroNinja can definitely become an addicting behavior if you go on there and you're looking at different wells and their history and their logs and everything. So yeah, just sharing some of the main ones, and we will continue to do these every 6 months or so here as time goes on. So I think I'll wrap it up there on this, and happy to cover sort of singular wells as time goes on as well. But mostly they will all be covered in the PetroNinja wells update, which is now going to be every 6 months. So with that, appreciate everybody joining here. We're going to go into a little brief Q&A, but for those who are not going to stay for that, appreciate your time. Happy Sunday. Always fun to chat technical and go into the details a bit. And especially for me, it's not just about looking at the wells where they are today. It's about what they tell you about what's to come. That's really the more important part, especially for people that are investing now in these companies for a longer term hold period. Getting to know some of the upside in these will give you a better insight, a better edge, as opposed to looking at just today's share price and today's cash flow and today's reserves. That tells you maybe 20, 30, 40% of the story. For some of these other companies, especially the conventional companies, there's a lot of other work to be done to really understand what they do and what sort of acreage do they really hold as the cycle continues. Okay, so we'll move into Q&A here. I missed a few questions earlier, so I'll go up a bit and then come back down here. So there's a question here on 88 Energy. I talked about that pretty deeply in my Alaska session last week. It's also covered in my Q&A portion of my presentations for the last 2 or 3 months, because I got a lot of questions on it. Keystone Gulf Petroleum, I don't really have any strong comments on this. It does trade at a very, very cheap multiple, obviously so, because they're in the Kurdistan region. The one thing I can give you is on June 18th, as part of my junior company session, I will be talking about Shamaran Petroleum, which is in the Kurdistan area, and can share some more thoughts on Keystone at that time, but not a company I would hold. I don't want anything in the Kurdistan region, and my fears have come true with the month-long prolonged shutdown that they're currently going through. I got these questions answered. So what are your thoughts on this Spartan Delta sale to Crescent Point? So I like the assets that they sold. They were really good assets. I was pretty bullish on Spartan Delta ever since they started, ever since they converted that return energy into Spartan. Was pretty bullish on their Montney. As some of you know, I did work on the Velvet acreage that they bought, including getting the first few wells started up in that area, in the Gold Creek area, and was very excited by that prospect that Spartan Delta ended up getting. Do I think the Spartan Delta company is better with the sale? Likely not, but it was a good way for them to monetize this part of the asset, keep the Logan assets, and then also keep the existing Deep Basin asset in the Spartan Delta company. So it was kind of an interesting way that they did it. They were able to get their money out in a sense. and then paid back in that special dividend, $9.50 plus the 10 cents, plus the Logan shares, obviously. And I think Crescent Point is going to have a good time with these assets. They're pretty good, lower decline assets. They are pretty well delineated. A lot of inventory here. I like the Montney way better than the Duvernay. So from that standpoint, it's pretty good. There is quite a bit of infrastructure now in the area. They might still need to build out a bit more, but it is still there. And overall, just a win-win transaction. It gives the Logan Energy team a chance to further delineate some of the other acreage, which I'm excited to see the results, especially from all companies in the Simonette and what's happening there, along with the other Montney overall lands. So pretty good deal, win-win. Valuation was relatively fair, I think, to both parties in this case. And it just depends what the pricing regime is over the next 5 to 10 years as to whether Crescent Point got a steal or whether they may be overpaid. But I think it's going to be hard to make a case that Crescent Point overpaid on this transaction, no matter really how you slice it over the next 3 to 5 to 7 years. So there's a comment here. I would rather see share buybacks if capital cannot be put to use in an accretive way. Yeah, no, 100%. 100%. I'm totally on board with that. I even think that share buybacks are a better use of capital than debt pay down. So companies that are going way too conservative on their balance sheets are not doing the right duty for their shareholders, in my opinion. I think there's a case to be made that you should have a reasonable amount of debt on your balance sheet, especially if it's legacy debt that's at 2, 3, 4%. If you're paying back that debt, what you're telling me is that you as a management team think you cannot create more value from that dollar than the 4% debt you're paying back or than the 3% debt you're paying back. I get the argument about it's a cleaner company. We're not liable to the shareholder, to the banks. We're not liable to term debt and all this. I get that argument. I just don't agree with it. So you should be able to, as a management team, run a company with a reasonable amount of debt on it. It's much easier to run companies that are debt free. So I'm just not interested in paying management teams egregious amounts of money to run debt free companies. And you can see that with the portfolio that I run. Very few, if any, are of that sort of nature or very low debt nature. Whitecap Q1 featured a lot of wells beating their IPs. Yeah, that's all true. I mean, that's exactly what I showed you here today. The Viking, the Cardium, and the Viking and the Glock is all looking good, beating type curves. I don't think they're cherry picking quite yet, although it will be interesting to see if they can continually produce really good wells going forward, rather than these just being one-off wells in certain sweet spots of their acreage. Any thoughts on the wells of Tamarack and Seal? No, nothing else really has been standing out to me. I'm sure there's other wells out there that are being drilled, and everybody had their arms in a row over Tamarack's well in Peavine hitting 40 barrels per day. Big deal. If they hit the next one and it's another 40 barrels per day, okay. If they hit 5 that are 40 barrels per day, okay, you just spent $5.5, $6 million, $7 million. And then you hit one that's 800 barrels per day, similar to Baytex. That's exactly what I want you to do. I don't want you to lose your confidence because you drilled 1 or 2 or 3 wells that were below whatever curve was being ran. I think the wells are so cheap in the Clearwater, that's especially where Tamarack is. Like, they're right next to Baytex. I think it's worth doing this no matter what. And that's essentially what gives you the chance to hit these monster wells is a few missed wells. Not every well is going to be good. And even a 40 barrel per day well is not the end of the world. You didn't just waste all your money. You're still making whatever money you're making out of that. Why was Surge share price hit so hard after Q1 results? Market's going to do what the market's going to do. And, let's not kid ourselves. Surge is a financially leveraged equity at a time when the price of oil fell in the same week that they reported the results. The price of oil fell $10 in 3 days. So, I mean, are you ever going to find an explanation for it that exactly tells you why it went down? I don't really think so. I think it's just financial leverage. Any company that has more financial leverage and then the price of oil drops is going to be impacted more, both ways. It goes both ways, up or down. Do you intend to keep Meg even the royalties kick in soon? How do you see this play out? Yeah, I mean, people have been telling me about these royalties for 14, 16, 18 months now. I think it's pretty well known. Don't necessarily care about it. It's already incorporated into my price targets model, the impact of the increased royalties. There's people that are saying wrong things about the royalties. The pre-payout royalties are on gross revenue. The post-payout royalties are on net revenue. So don't just go by the percent that people are telling you. The royalty is going from 9% to 38%. No, 9% of gross revenue to 38% of net revenue. So the percentage change is actually not that big. I'll let people run their own numbers rather than me bias you with how I think it plays out, but I really don't think it's a big deal. Now, since you're asking this question as is, Meg does trade at a premium to their peers. And when I say peers, not the oil sand peers, but the high liquids percentage oil peers. Whether the company is the same size or not, doesn't really matter. Meg does trade at a higher valuation. So however you want to see that is kind of up to you. But I don't think it's a royalties. That's the part that's making the difference. It's just the fact that if Meg continues to trade at a superior valuation and the gap continues to increase, you can make a case for moving down market into a different name. So that's the way that I'll sort of answer that question. Yeah. What would you suggest as a best allocation of capital for Surge going forward? What acreage would you suggest they prioritize? Is the growth path in the current price environment? So Surge, I think, runs a very complicated ship in that they change their plans for wells and drilling depending on what commodity prices are. So if prices are lower, do we really want to blow out our high decline Frobishers in a low price environment? No. So we should not be drilling too many Frobishers at this point. Sparky, yeah, because the Sparky can go under water flood, and the Sparky wells have a mitigated decline anyway, likely worth doing. At this point, I think Surge should just do the bare minimum to keep their production flat / grow 3 to 5%. That's it. The other part of what they have, the undeveloped land and the other acreage, should be a 85 to $90+ oil business. It doesn't need to be drilled now. It doesn't need to be delineated now. It just needs to stay there. Surge, I don't think is going to be all that aggressive on their buybacks, to be honest with you. It's not a model that they've ever ran. It's not a model that I see them running, especially given that they have created a lot of shares in the last 2 years with acquisitions and other purchases. So I don't think they go the buyback route. I don't think the dividend is all that attractive to be grown to a much higher range than what it is at already. So I think they just stay still here. They just stay still until oil is 85, 90, 90+. And then I would go hyper aggressive on delineation, not growth, delineation of their unexplored and undeveloped lands, and try and monetize those in a certain way. Like try and drill a few wells and prove out the acreage and then either sell it or leave it there as whenever Surge ends up hitting the market as an entity for sale, you say, oh, look, we got 10 different Sparky pools with all this inventory that can be bought out, and we've barely developed it, but we've delineated it, so you can have it. I think that's the model that Surge should run in a attempt to get a really good exit, maybe 12, 18, 24 months down the road at a very high cash flow multiple, along with all the undeveloped land that's there with it. I don't think Surge should become a growth company. because you're just blowing through inventory, and then it becomes harder to sell the company down the road. Is there any room for growth from large market caps? I don't really track the large market caps. They trade way too expensive for me. Exxon Mobil and Chevron and BP, Shell, and Total they trade much more expensive than small to mid caps. And I am in oil and gas companies to hit home runs and hit grand slams. I'm not here to bunt and hit singles. So again, this is my own interpretation. You may have your own different subjective portfolio construction. You may run your own sort of portfolio and risk tolerance. Obviously, the bigger caps have less risk on them as far as downside risk goes. But I also think they have higher risk as far as downside risk goes, because when your large cap is trading at 6 times cash flow and my mid cap is trading at 3 times cash flow, which one has more downside risk? In a scenario where oil prices drop, I would argue the large caps have a more of a downside risk on them. Anything that trades at a higher multiple, just in general, would have a higher downside risk. And that's my reasoning for being more in the mid-sized companies, is that not only do I get the upside torque, but also I'm paying half the price versus some of the bigger companies. So it just makes sense to me to be there. Would you buy Tamarack at this low share price? I mean, it's still in my portfolio, so I don't see why that would change anytime soon. I've shared this story before, but so many people who I got into Surge, not because I gave them advice, but because I told them about Surge in 2021, got frustrated and they sold it at the lows, or they sold it when it ran up 30, 40, 50%, and it still hasn't come down to $7 for them to rebuy, $6.50 or $7 for them to rebuy. It proceeded to run up another 100% from that point in the next 4 months after that. So I invest in these for a reason, because these companies that I have are set up for a 90, 100, 110, 120 price environment. We have not been in that price environment for the last 6 to 9 months. So to say their share price has gotten hammered, it doesn't surprise me. That's just the way these companies are. They're torqued up both ways, and they're not built for a $75 oil environment. They're built for a $90+ oil environment. And the rest is sort of up to you. Like, what do you think? What sort of oil macro are you betting on? And then we can pick companies that are best suited towards those sorts of oil macro situations. So for me, people that know me, they know I believe in a higher for longer cycle, and higher for longer means 100+ forever. Once we get there and we sustain there, we will stay in a 100+ cycle forever. We'll go up and then we'll come down to 120 or 110 will be the place where we settle down to on the bottom end of things. So in that sort of cycle, the companies that I have, very happy to stay in them. No, I've made no changes in months at this point to my portfolio. So Brian, Tamarack in a talk said they got 425 combined production from 3 zones in Seal. Yes, so that's how they drilled that well. They drilled 3 legs, I want to say, on 3 different zones, right on top of each other, and that's kind of where they left it. Like, there's not enough information right now to go and make any sort of conclusion, positive or negative. It's good so far. One of the zones was a lot better. It was at 100 and something barrels, I want to say, per day. The one zone was at 30 something. And hopefully we're talking about the same well here, but not conclusive enough to say anything. I will keep repeating the same point. I invest in companies that have the acreage to make me money through the cycle. That's pretty much all I can do. And as they continue to delineate, I can follow up, I can keep in track as to what's happening. But for me to sell the company based on a month or 2 of production, not exactly how I roll. Not judging anybody, not making any comments about what you're doing. That's just not the way that I roll. I buy companies with good acreage, good cash flow, good reserves, good free cash flow, and I buy them for the cycle as time goes on here. Why is Baytex at $4 to $5 a share when its earnings were $1.52 a share? So I would not use earnings in oil and gas companies. Use free cash flow multiples or reserve multiples. Earnings are useless in oil and gas. You can move earnings here and there by removing reserves or adding reserves. So I'll just give you my opinion. I don't look at earnings at all. It does not mean anything. It can be juiced up or squeezed out one way or another, depending on what the company wants to show for that quarter. Should it be a bit higher after acquisition of Ranger? I mean, that depends. I don't think the Ranger deal is a good deal. So should the share price be higher after the deal? I don't think so. And they've lost their Canadian base. They are pushing for the US investor. Are they going to get the US investor? Maybe. Would it take 12 months? Maybe. But I think they've lost the Canadian aura after they've gone into the Eagle Ford Shale. Not a company that I even care to even look at, despite their success in the Peavine and despite their success in Morinville now, doing the Clearwater drilling. Do you have any thoughts on Rock? No, I don't really have any thoughts on Rock at this point. They've done a really good transaction. They're selling Weyburn for a really high price. They have a drilling plan here for 2023. The second half plan, I don't think is fully committed yet. So we'll see, depending on WTI price, what sort of plan they commit to. They retired a lot of the term debt. Yeah, reduce their hedges. Yes. What should they do with the cash flow? I mean, they can do anything they want. They can drill more wells. They can go and acquire more acreage. I was kind of surprised they didn't buy Vermilion's package, that 5,500 BOEs that Vermilion sold. Pretty good price, $225 million. It was, I mean, pretty decent price for a company that was relatively aggressive in that area. Depending on what kind of support they have, obviously, on the debt and equity markets. But they have a lot of options they can do, and that's why this company is no longer attractive to me. They've paid off too much debt, and now it's just too clean, and the drilling results are not coming out as strong as some of the other companies that I own. So that's basically it. They do have, though, a really strong plan, and looks like they're going to work on some Cardium drills, some Southeast Saskatchewan stuff, and just grow the company as time goes on. Do you agree with their plan to spend the cash on the drill bit versus buying back stock? I mean, it's a growth company, right? For them to buy back stock, maybe the warrants, yes, I would buy them back 100%, because they offer a lot of upside. And when you can remove upside from the investor's hands into the company's hands, buying them back cheap does make sense. Although they may not hurt if these warrants are exercised at some point in the future and it brings cash into the company. But yeah, I don't think I would be pushing back for stock buybacks on small growth companies. It just, even if they trade cheap, it's just not a good use of cash. When things are trading, when your peers are also trading at the same multiple, I would just buy them as opposed to buy back stock, which is why I'm so happy with Surge doing their acquisitions as opposed to buying back stock or paying a much higher dividend. I think 5.5% to 6% is more than enough at this point. Okay, yeah, no, appreciate everybody joining. It's always awesome to see you. Always some great questions, and I haven't had the chance to do Q&A for a little bit because of the kind of the amount of length of the sessions that they've gone to. So glad to kind of finally do this and be a bit more active. I'm going to New York next week, so I won't be active for the next couple of weeks. And then I think we have the next session on the 28th, if I'm not mistaken. So let's keep on keeping on. On Prospera's plans, I have a full session on that coming up here shortly in the next, call it 2 weeks to a month. And I hope to share more details as that comes out in a full session rather than just doing verbally here. I will show you on PetroNinja and on the exact logs and on the exact devices and drilling. I'll show you exactly what they're planning. And I'm just waiting for more information. along with me wanting to do a specific session on them rather than just give you half information without backing it up. No idea. No idea on this question. I like the UCP because we get those royalty credits on asset retirement obligations, which would be fantastic. But as far as who's worried or who's going to be in charge, I don't really have an opinion. I don't follow politics. I think politics for the most part just doesn't matter. People put too much emphasis on who's better and who's worse. You almost got to deal with things as they are. Is a better use of time, and I think managements are the same way for the most part. Yes, I do have the Twitter space with Serge coming up tomorrow. I've got some specific questions that I have targeted to ask him, which will make it clear some of the undeveloped upside and some of the other caveats that they, for some reason, they don't put them in their news releases. They're very energetic and very passionate, but also very conservative in what they give you, which is a very interesting combo. You don't usually get that sort of combo in the oil patch or in markets in general. Yeah. I mean, Tamarack's just doing what Tamarack's doing. I'm not in a position to tell them to do things any differently, and I believe in the geology. My portfolio these days is more rooted in geology than it is in business plans, if that makes sense. I like assets that are tier one, that are core of the core, that have a lot of oil in place, that have low recovery factors, that can be produced with new technologies, that have a lot of wells to be reactivated. I like that part of things. And then you add onto that my view on the commodity price and where it's going, and things will just work out. That's pretty much the best and most simplest way I can put it. Nitpicking companies' business plans and where they're allocating capital, you may have a 1 or 2% difference in the company's trajectory by doing that. Not worth my time for the most part. Yeah, I did look at PetroTal actually very recently. Just doesn't get me excited anymore, because 12 to 18 months ago, PetroTal was being compared to my Surge, my Obsidian, my Tamarack holdings, and at that point, it was attractive on a peer-to-peer basis. Now, if you ask me if I want to add on risk to my investments or torque, I would rather do it by allocating money to junior companies in Canada, as opposed to taking on the risk of going to a jurisdiction that I know nothing about. So now the PetroTals of the world are competing against my junior companies, and it doesn't compete. On a free cash flow basis, maybe it does compete, but on a cyclical investment basis over the next 2 to 3 years, it does not compete. Surge shares outstanding are up 20% year over year. Yep. Yeah, they made the Enerplus acquisition. Part of that was funded through equity. They also had about $18 to $20 million equity raise in Q1. So yeah, pretty well-known information. Be careful using year-over-year metrics when companies have made acquisitions. It doesn't quite screen well, but I do understand the point you're trying to make. So for sure, and I'm more than happy if they make more acquisitions at 3 times cash flow at $80 or less WTI strip. Keep on keeping on. There's packages I specifically sent to Surge and said, buy this, and maybe something comes out of that in the future. Maybe it doesn't. But as many of you know, I keep a very close eye on stuff that's being sold. Different packages out there that I think could be bought for a very good price out of distressed companies or private cos or family-run companies, or even packages that are stuck within a Baytex or a Crescent Point or a whatever Vermilion, etc. Packages that are getting no love, getting no attention, that could possibly be taken out of those. And I'm talking like 1,000 to 3,000 to 5,000 BOEs per day packages, not the tiny little ones. And I've sent that to them, and we'll see. Maybe something comes out of it. But I'm more than on board with them doing this. If they got to take on debt, and issue equity in some sort of 50-50 mix. Yeah, more than happy for that. For those that are not really aware, companies in 2012 to 2014 were trading at 10 to 13 times cash flow. They were trading at $100,000 to $150,000 a flowing barrel. So now people can tell me all they want that it's not going to happen again. How do you know it's not going to happen again? So effectively, it's just a he said, she said sort of transaction, and that's what makes market. So I'm happily willing to bet that in a stable oil price environment at a much higher price, you will see cash flow metrics go to levels that people today may call you crazy for. So it's too early to say this isn't going to happen or that's not going to happen. Yeah, the Surge interview is on Twitter Spaces. Yes, it's going to be 2 p.m. Mountain, I believe, is when it is. We'll start with a little 10 to 15 minute overview. I've got a few questions that I'll ask just to set the room up 10, 15, 20 minutes, and then we'll open it up to the audience for any further questions and try and keep it to an hour. I've been kind of trying to not let these Twitter Spaces ramble on and on. The ones with the CEOs, because it can get a bit much from their side since they're not used to taking meetings that are hours long. So probably an hour or an hour 15 at max, and probably wrap it up there. Will you be adding a financial component to your presentations, paper longs, short sellers? Not really. That will all be covered through my Twitter feed. So whatever I post on there is supply demand fundamental based information. So we'll continue keeping that as is. I don't really want to have this become like a repeating the same thing over and over and over. So that's why I've moved my macro to every 6 months. I've moved the PetroNinja Wells update to every 6 months, stopped the company valuations, and moved to more of a macro update. I have a few other sessions planned for Q3. So I'm already getting some really good ideas and also some good suggestions. So I've got some coming up on how to value infrastructure and pipeline assets that these companies own, how to value undeveloped land. That's going to come up later on in July, August, not yet scheduled. I have one on the Canadian oil sands, all the projects, what they do, how much they produce, what they cost, all the new potential projects. So some pretty cool stuff that I'm looking forward to share here as the year continues. Should be a fun little ride throughout. So Pieridae has a skewed risk reward right now. You think any residual value for LNG call? No. The Pieridae LNG never had any value. It never had any value. It's never going to have any value because the company cannot put up the money to do that kind of project, and we would not want them to do that kind of project anyway. So I would say if you're looking at Pieridae, look at it from a strict risk reward standpoint on current production and the new drills, and then the sulfur production and the NGLs and the condensate. That's it. I don't think I would bake in any sort of a value for these like one-off things. And I don't even know why they market themselves as that they don't have the money at all to do that sort of project, or it would cost so much dilution in the company, it just wouldn't make any sense. And it would be similar to a company doing an oil sands project now. Your share price would just get absolutely hammered because the project's not going to start for many, many years, be online for many, many years. Yeah, I think we'll wrap it up on this question. So the question is, do you equate the Oilers beating the Golden Knights with increased cash flow for Canadian juniors? Yeah, I honestly don't really know, but I do know that if the cycle goes exactly as we think it's going to, or as I've set up my portfolio to how it's going to, Las Vegas is going to get a lot of my money. So that's basically where we'll wrap it up. And hey, it's always great to see a Canadian team doing well here in the playoffs. So we will keep on supporting. And with that, thank you to everybody that tuned in here on your Sunday. And I hope you enjoyed this. We will keep on keeping on, keep these going. And we will see you at the, either the Twitter space tomorrow or somewhere else here as time goes on. So cheers.